case you missed it, on Bloomberg, the China show.
What's been the sentiment? What's been the reaction to this U.S. election outcome on the ground?
They were pretty much ready for Donald Trump. There was a high expectation that he could return to the White House.
We have dealt with him before, and after quite a few years, China simply is better prepared, and China, psychologically speaking, is much more prepared in dealing with him again.
Probably are fully prepared for Trump to impose higher tariffs on China.
What's the tone as they were talking to really a global investment?
Right. The openness of China, including the capital markets, Hong Kong being an international financial center, will be extremely important in channeling global investors.
Don't miss the China Show live every weekday.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Rio de Janeiro, Brazil, and this is Bloomberg.
Closer to the weekend, equity futures here up by 0.4% on the S&P 500. In the bond market, bond yields down again by 2 basis points, 4.59 off the back of the economic data and some dovish Fed speak from Governor Waller, which we'll talk about in just a moment. And the surveillance this morning, tariff threats boosting the US dollar.
The American people should think about tariffs in 3 ways under the Trump administration. 1 will be for remedying unfair trade practices. 2, maybe for a more generalized tariff as a revenue raiser for the federal budget. And 3, sanctions may be driving countries out of the use of the U.S. dollar, so the tariffs can be used for negotiation.
So here's the latest this morning. Markets bracing for President-elect Donald Trump's trade policies. The dollar hovering near 2-year highs as tariff uncertainty weighs on global currencies. Jane Foley of Rabobank writing, Trump may be prepared to back down on his previous preference for a weaker US dollar, particularly if he views that tariffs can do the heavy lifting on addressing the US trade imbalance. Jane joins us now for more. Jane, didn't work last time. Can it work this time?
Well, I think things are a little bit different this time, and I think we know that Trump is an experienced politician. He's also, I think, ready to hit the ground running next week, and I think this time next week we'll be able to answer that question with a lot more clarity, because if he comes through very quickly with executive orders, the market's going to get a very strong flavour as to whether or not what it's priced in terms of tariffs, in terms of growth, in terms of inflation, is really, broad-based correct or not.
Well, Jane, what do you think is behind the dollar move we've seen? Is it rate differentials off the back of superior economic growth and inferior growth abroad? Or is it really about anticipating the policy changes from the incoming administration?
It's both. Certainly, if we just take a snapshot of the US economy now and compare it with, for instance, Germany, China, what we see is a lot more strength. For instance, if you look at the forecast for growth in the US this year, they're averaging around about 2%. The consensus is around 2% for the US. It's about half of that for the Eurozone. Obviously, we all know that China's still got growth struggles, even though it did hit its target for 2024. So that there is a better growth outlook. And with that, there is evidence of sticky inflation in the US. So that's the snapshot right now. And on top of that, we need to layer in the potential inflationary impacts of tariffs, or of mass deportations, for instance. That could certainly create a more tightness in the labour market, where a very significant proportion of the workers in the US are foreign born. Now, obviously, a lot of those have got documentation, but even so, we could certainly see some inflation or wage prices coming through in certain sectors, so agricultural workers, etc., and some others. So we do anticipate more inflation. The market is anticipating more inflation from Trump, but that's layered on top of what is a pretty robust economy already.
I understand these things are hard to disaggregate. Scott Bessent did take a run at it yesterday when he said for every 10% increase in tariffs, you would see a 4% move in currency markets. Jane, does that math square for you?
It is difficult because who are these tariffs going to be on? What about the tit-for-tat tariffs? There is so much to say. So it's very difficult, I think, to say with any certainty that that's exactly the rule of thumb that we can follow. But one thing that I think is going to be very, very interesting during this, the next few years under Trump is to what extent tariffs are used for foreign policy. Now, we had some indication from Bessent yesterday saying that tariffs could be used for broader reasons. We had Trump a week or so ago in his press conference, talking about the economic power that he could exert on Canada, for instance. To what extent are we going to have this different type of statecraft really under Donald Trump, whereas tariffs are used not just for economic policy objectives in the US, but for foreign policy objectives in the US? And that is a different ballgame, which is very difficult to measure.
It's something Terry Haynes has been writing about at Pangea for some time. Jane, but it's for those uncertainties that you get something like the reporting we've heard out of the Bank of Japan, that officials there do and are leaning towards a hike at the end of next week, but want to wait until Monday, until we get Trump's inauguration, to understand what sort of executive actions he would take. What is the path that Trump might take that would either derail BOJ from hiking or give them the green light?
Well, I presume if Trump were to indicate that Japan was not in the center of the sights in terms of tariffs. But, Japan, I think, is in a very interesting, potentially quite a strong position, because we've got to remember that Japan not only is, the largest holder of U.S. treasuries outside of the U.S., but it's also the biggest provider of U.S. FDI. And, of course, over the last, compared, say, to 30 years ago, the geopolitics between the U.S. and Japan have changed significantly. Whereas, in 30 or so years ago, the U.S. really forced Japan to move away from its semiconductor business if it was going to protect its manufacturing sector, and really forced Japan, to move large auto plants, for instance, into the US. Now, Japan sees itself more in certain areas, particularly tech, as more of a collaborator, and that relationship, I think, could be strengthened in areas as defense going forward. So those sorts of indication perhaps give Japan a little bit more strength in terms of the hand that it has got on offer to play against Donald Trump. So certainly not as vulnerable in terms of trade as perhaps China, maybe not even as vulnerable as Germany, for instance. But I think that's going to become a lot clearer over the next few weeks.
And also warming up to the president-elect, Japan will also be sending their foreign minister to the inauguration on Monday. Jane, I'd love to get your thoughts on one thing Scott Bessent said yesterday about sanctions. He said Trump thought that potentially the U.S. has gone over its skis on sanctions because of de-dollarization. Do you think sanctions are leading to de-dollarization around the world?
Well, if we look purely at just the IMF data, there is not that evidence yet. In fact, if we look back over the last 20 years, there is evidence of de-dollarization, but actually where central bank reserves have moved into other currencies, it has tended to be maybe the Aussie or the Canada currencies, perhaps where over the last 20 years there has been some yield, for instance. So there isn't any firm evidence in the IMF data yet. But there does appear to be a logic behind the fact that if you are going to be applied by US sanctions, then it is in your incentive to stop using the US dollar. And we have seen, for instance, China set up its different payment system, for instance. We have seen some more spread of that between its trading allies. So it would appear logical that if you were to issue more and more sanctions, that you will eventually chase countries away from using the dollar. So there is, I think, a logic in that. And therefore, again, it comes back to how far can tariffs be used as a replacement. So this different type of statecraft where foreign policy aims can be used again by tariffs potentially, not just economic policy aims.
Jane, quickly, just before you go, help me out with something before you leave. How do you explain the difference between Governor Waller and President Hammack on the FOMC, because the Cleveland Fed president is saying things like we still have an inflation problem, monetary policy is only moderately restrictive, and Governor Waller came out in the last 24 hours signaling he's open to plenty of rate cuts in 25. What's that about?
Well, that is surprising, but certainly, we have this in the Bank of England too. We have this in the Bank of Japan. I mean, this is why there is a whole council, making policy decisions. We need all those different points of views. And of course, at the end of the day, it's which way the majority vote will go. And listening to many of the other Fed officials, it would certainly suggest to me that the majority is one of a cautious outlook now, leaving Waller perhaps as an outlier.
Jane, appreciate your time. As always, Jane Foley of Rabobank there on the FX market. We are poised. We're set for another week of dollar weakness, and only the second week of dollar weakness that we've had in around 4 months. I think we went through the whole of Q4 with only 1 week of dollar weakness, so that's one. This will be the second one.
A lot of it is due to the U.S. data over the past week. But again, how does this set us up for Monday? If we do get some real executive actions, does that mean we're going to get a pop in the dollar and pop in the yields higher? It's this kind of asymmetry we like to talk about.
I know I sound like a broken record now, but we'll see. Watch this space. I mean, it all comes down to next week in many ways for many of you I know. Up next on the program, we'll catch up with Matt Miskin of John Hancock, Michael Townsend of Charles Schwab, Norman Rule of CSIS, and Mark Kelly of Stifel, the second hour of Bloomberg Surveillance. Next.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
You are also an owner, I should have pointed out, of 3 major sports teams.
That's right.
Right? And you're the first woman, as I understand it, the first woman to own 3 major, have a stake in 3 major sports teams. Is that right?
Yes, and we'll say African American.
You were approached by the owner then of the Washington Wizards and the Washington Caps about maybe buying the Washington Mystics, which is the women's basketball team. And what did you say?
Well, first of all, it was Abe Pollin. He did come to me and Susan O'Malley, and they said, Abe Pollin says, look, I want you to be the face of the Washington Mystics. And I said, what do you mean be the face of? He says, I want you to buy this team. His health was failing. And I have to tell you, and a lot of women can understand this, we never get these opportunities. So that was the first thing that struck me, and I was flattered. I was really flattered. I said, well, Abe, what are the financials on this? And he handed them to me. He says, well, they're not making money. But I was still intrigued about team ownership.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Bloomberg brings you breaking news 24 hours a day, powered by 2,900 journalists and analysts in more than 150 offices across the globe. Bloomberg Television. Context changes everything.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
We are at a delicate point for the Fed, but I don't think they'll get too preemptive in this environment.
We came into this year with the thinking that inflation would probably hang at a level higher than what most market participants expected. We have one more rate cut kind of penciled into this year.
As it stands today, we're still looking at anywhere from 0 to 2 cuts this year, and the first cut in the second half of the year still seems likely.
The next round of cuts will likely need to come because they should.
How much lower can we really go on rates given where the Fed is and given where inflation is? I think that's the big question.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
If you came into this week bullish, you've had a great week. Everything's gone your way. The earnings from the big banks on Wall Street were decent. We had a downside surprise on CPI, on PPI. Retail sales was okay. And Governor Waller was super dovish. And we're set for the biggest week of gains on the S&P since election week in early November. Equity futures adding some weight to the rally. We're higher by 0.3%. On the Nasdaq 100 up by a third as well. And likewise on the Russell going into the big one next week. Inauguration on Monday.
Well, I think Isaac said it best. We're going into 5th year of Trump, not the 1st year. We know the direction of travel on a number of issues like immigration, like energy, like deregulation, and like tariffs. The issue is we do not know the nuance of some of these policies, and that is really what the market is waiting to learn.
It's not clear we'll actually learn that come Monday either. That's one of the issues here. But if the market doesn't learn that, that might be a good thing, because there is this anticipation being built up, especially after the rally of this week, this fear that we're going to get something that sets markets up. If we get past it and maybe we don't get details, it could be, hey, the event risk is past. We can go ahead and buy duration.
Big sigh of relief. We're buying duration right now. Yields are down across the curve on a 10-year and a 30-year. For a third consecutive day, we've got yields falling. Danny, we're down 2 or 3 basis points on 10s to 458.44. There are a lot of people on the street who have closed the door on the potential for a rate cut through 2025. Morgan Stanley's Mike Apen is not one. He says this: the door is still open to a March rate cut.
And you'd have to imagine that it is open after Governor Waller yesterday, too. I mean, really, really stunning. Just after the market had priced out the odds of a cut in the first half of the year, Waller coming out and saying if the data continues to look like it does, they'll be able to cut. Not improve, just continue. And I think we need to reiterate, CPI was 0.002% from being in line versus weaker than expected.
We could have been having a very, very different conversation. Going into the weekend, the quiet period begins, so no Fed speak through next week. I know many of you appreciate that. And then it's on to the following week when we get the Federal Reserve decision on the Wednesday at the end of this month. Feels like the last Fed decision was only last week. Time's flying. Equity futures on the S&P up by 0.25%. Coming up on the program, Matt Miskin of John Hancock as Wall Street awaits Trump's inauguration. Michael Townsend of Charles Schwab looking ahead to his first 100 days in office. And Mark Kelly of Stifel and a potential 11th hour rescue for TikTok. We begin this hour with stocks steady and bond yields moving lower. Investors focusing on President-elect Donald Trump's first day in office. Matt Miskin of John Hancock saying we are likely moving to a new macro regime here as we have to say goodbye to Goldilocks. Before, the data was not too hot and not too cold, which left the Fed supportive to markets. Now the data is coming in hotter nearly across the board. Matt joins us now for more. Matt, welcome to the program. Did this week change things for you in any way, shape or form?
The Philly Fed index, John, was through the roof. I mean, it's a little too sunny in Philadelphia right now, it almost seems like. And when you see across the board, I mean, the NFIB survey also, I mean, some of these moves in the economic data almost look like meme stocks in terms of their parabolic upside. And when you see this, and then you hear the Fed, or FOMC members like Waller, as you've been addressing, saying they're still going to be cutting it, it's hard to put those two pieces together. But at the end of the day, you got to position more for a reacceleration of growth. We're looking down in cap, mid-cap stocks, industrials. We've been talking about them for a long time. But frankly, the earnings are looking good. They're starting to get more appreciation, relative strength. And if there's more onshoring CapEx, that's our favorite place to be in global equities.
So, Matt, let's build on that. How further down in market cap would you come? And would you go down to small caps? And let's just talk about the Russell. Can small caps work without interest rates coming down?
We don't believe so, John. And that is the big difference about reading this macro regime. It's almost like the macro regime playbook is missing pages here, or the pages are so dated you have to go back and get a new edition, because the small cap indices are just different than what they used to be 10, 20 years ago. Now, in a booming economy, 40% of the companies don't make money. And so they really actually would prefer a zero interest rate regime more than a strong economic regime. And mid-cap, on the other hand, 85, 90% are profitable. You're getting more industrial exposure. You're still getting financials, but that industrial exposure typically is higher quality with a higher ROE. So if you want quality and value combined, which is basically our mantra, quality at a reasonable price, we would go to mid-cap. Mid-cap may be the new small cap to implement for this kind of macro regime.
Matt, can I go back to what you were saying about data looking like meme stocks? Peter Schiff of Academy had basically the same read as you, but his conclusion was something is wrong with the data, that you can have a jobs report that comes in and 74 out of 75 economists have a number in expectation below 200,000, yet it surprises to the upside. Is there a factor that maybe the data, as hot as it's showing, is just not correct?
It could be. I mean, you know, at the end of the day, these are surveys, and surveys have been the hardest thing to read over this whole cycle. Since COVID, basically surveys have been broken. Leading economic indicators, surveys that are trying to lead the economy have just frankly been wrong. They were overly pessimistic over the last couple of years as the economy chugged along pretty well, and now they've really whiplashed into more positive, kind of more optimist type outlooks. Now, does real GDP improve? Does other activity improve? We'll just have to see. But you've seen such a flip of the switch on survey data. At the end of the day, though, we're seeing it in markets. I mean, even just to start this year, I think in the best way, you know, LL Cool J may have said it best. Don't call it a comeback. You're seeing the markets rotate. Industrials, financials, materials are all starting to do better. Tech isn't working. I know this is like stunning for markets after 2 years of just tech domination, but a rotation's happening in markets, and that's reflecting probably what's happening in the economy, a better economic outcome.
I mean, you see that with an S&P that declines yesterday. Even so, 75% of the constituents of the S&P were up yesterday. The equal weighted is on track for its second best week over the past year. The only week that was better was after the inauguration of Donald Trump. Matt, how enduring is that broadening? Is that better breadth of the market?
We've been saying that it's got to be an earnings-driven rotation in financials this week. Now, they had low base effects. Q4 of 2023 is when the SVB payouts happened. So that really hurt Q4 of 2023 earnings. And then Q4 of 2024 earnings were strong on top of that. But investment banking, you know, you were all just talking about this. Investment banking businesses are starting to come back and starting to get more strength. We're seeing, you know, the yield curve steepen. That helps financials. Financials are the biggest value sector. It's really tech versus financials if you're trying to make a growth versus value decision, if you're going to see that rotation. But the great news of this week was really actually the fundamental side, and it was all those beats by the big banks.
You say that the Fed is likely done holding markets' hands. So then what do you make of Governor Waller yesterday?
To me, it was an outlier. And this is where it gets difficult listening to FOMC members because they're going to be all over the place. And if this divergence really happens over the next couple months, I don't think it really helps markets. It's just going to add uncertainty. But if you're data dependent, I don't get it. I mean, you just talked about how the CPI report beat by 0.002%. And trillions of dollars were moved across markets. And even in this little bit, as soon as inflation comes down a little bit, you get this speculative frenzy back in things like crypto. And that's not going to help your inflation problem or your kind of that speculative nature or sentiment of markets. So
Matt, let's address it. Can I just jump in? Is Governor Waller data dependent, or is he Fed chair vacant seat dependent?
I think that's the latter. I think there's other motives, but you know, at the end of the day, you know, over the course of the year, I think he could be right. I think the way we're looking at this is a two-half story for Fed in 2025. The first half, I think they have to be hawkish. I think they have to back off, let the economy settle in, see what happens, and in the back half, I do think they're going to be cutting. But it's hard to say right now, look, we're going to get it in the first half. I think you're just kind of bringing forward an inflationary impulse that you really would rather not have up front here as we're going to reset into the beginning of 2025, a lot of the inflation. And commodities are coming back. That makes me a bit nervous on the inflation front, but it helps the cyclical side of equities. and that's what we're leaning into.
Well, Matt, let's stick with commodities for a minute. Scott Bessent yesterday took a moment to directly say if any Russian officials are watching his hearing right now, they should be on guard that potentially they will go after the biggest Russian oil producer, something we saw Biden do in the very last days of his administration. Did you get a sense that actually we're going to get a very hawkish Donald Trump administration when it comes to Russia and sanctions coming into office very shortly?
You know, I did not see that on the 2025 bingo card, but what we're seeing, yeah, you're right. I mean, and it's just interesting to see that the administration really waited to the end to kind of throw on these sanctions. And that is really where oil prices started to respond. Before, all the other sanctions or other supply issues was just kind of breezed over. I mean, WTI was more like $70. You know, it's kind of breaking that. It almost looked like it was going to break down even further. And then it just really has rallied here. If you wanted disinflation, that oil rise is not good news. But at the end of the day, look, commodities work in these kind of short-term spurts. Even copper is ripping. I think this also has to do with getting ahead of the tariffs more broadly and just trying to get as much inventory, whether it's supplies, finished goods, ahead of this as possible. You've seen it in the China data. China's basically having this huge export data. They need the commodities to do it. But I don't know if it's really sustainable. Frankly, we believe inflation is going to come down over the course of the year. We think housing prices moderate. So we would actually use this impulse and lean against it, actually maybe grab a little bit of duration here.
I mean, it's a lot, Matt. And only the 17th day so far of 2025. You'd think people would welcome a long weekend, but you know everybody's going to be glued to their screens waiting to see what happens on Monday in terms of executive orders. What's your read on how vulnerable the market is to any sort of action from Trump, be it on immigration or tariffs?
Right now, we're pricing in a lot of good news, and sentiment has really skyrocketed to be more positive. I think more broadly, what we're seeing is the biggest liability to this market is the positive sentiment. One of the best things this markets had going in to the last year or so was that it was pretty bearish. And the new administration has brought a lot of hope, a lot of optimism. Not necessarily a bad thing. Again, that's probably driven some economic activity and more CapEx, deregulation, all that. But at the same time, you got to be careful here, looking for everything to go right and thinking that it's all going to be kind of an easy way to navigate this macro backdrop. There is still policies that could kind of dent some economic growth. There is policies that could create volatility. So at the end of the day, you still got to think about risk management. And again, that would bring us to the bond market.
Matt Miskin, making tears rain down like a monsoon. Appreciate it, sir. Of John Hancock. Yes, you know. LL Cool J. I wasn't expecting that. LL Cool J lyrics from Matt Miskin.
I mean, it's TGIF. It's Friday, so why not?
Were you expecting It's Always Sunny in Philadelphia
I wanted
reference?
to, listen to the bass go boom explosion and then, anyway. All right, let's give you an update on stories elsewhere this morning. Here is your Bloomberg brief. TikTok looking poised to win a reprieve from a US ban. President-elect Donald Trump's team promising to give the Chinese owner more time to divest. Monday's White House transition effectively gives Trump's administration control over whether a ban is enforced. Elsewhere, Starbucks China chair Belinda Wong is retiring on January 24th. The CEO, Brian Niccol, crediting Wong with transforming Starbucks China into the company's largest international market. Wong's departure coming amid a global management reshuffling at the company. And finally, a concert to raise money for the Los Angeles wildfire victims will be held on January 30th. It will be broadcast on multiple streaming services, as well as in select AMC theaters. Billie Eilish, Lady Gaga and the Red Hot Chili Peppers are among those expected to perform. And that is your Bloomberg Brief. Up next on the program, markets bracing for day one.
On day one, we will begin the largest deportation operation in American history. I will also terminate the Biden-Harris electric vehicle mandate on day one.
Day one is just around the corner. Live from New York City this morning. Good morning.
investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Stocks doing okay here, positive by 1/3% on the S&P 500. Bond yields down 2. We're down by 3 basis points. The 10-year 458.24. Under surveillance this morning, markets bracing for day one.
On day one, we will begin the largest deportation operation in American history. I will also terminate the Biden-Harris electric vehicle mandate on day one and save the U.S. auto industry from destruction. That means two things on day one, right? Drill, baby, drill, and close our borders.
So here's the latest this morning. Traders gearing up for President-elect Donald Trump's return to the White House with major policy changes expected as early as Monday. Michael Townsend of Charles Schwab writing, market volatility may increase around reports of what is or is not included in executive orders and proposals. A well-diversified portfolio will remain appropriate as a busy year in Washington unfolds. Michael joins us now for more. Michael, you heard that sound there. That was the President-elect Donald Trump back in the summer, I think back in July, I believe. How different will day one be to what he was saying on the campaign?
Well, first of all, I think it's going to be really cold here for inauguration. So if you're coming to Washington, bundle up. It's going to be the coldest inauguration in 40 years. But beyond that, I think it's going to be interesting to see, how much can get done on day one, because there was an awful long list that was promised on day one, and I'm not sure there are enough hours in the day to make that happen. But obviously, investors, markets, companies really watching for the details on tariffs and on immigration in particular. So I think everyone is kind of on pins and needles to wait and see what the details are and whether they're, as extreme as the language has been on the campaign.
Michael, thank you. I will pack my base layers. I heard it's going to be cold. I appreciate the tip. Let's talk about the tariffs, because that is really where the uncertainty is. What is the scope that you think Donald Trump is willing to go early on when it comes to tariffs on, say, China, Europe, Canada, Mexico?
Yeah, I think it's been really interesting because all along here in Washington, I feel like there's been this kind of assumption that we're going to put tariffs on absolutely everything was sort of a rhetorical flourish, that there's probably going to be more nuance to it. But no, you talk to people inside the campaign and the transition, they're talking shock and awe on day one. So I think there's some real uncertainty about how far-reaching they'll be. There's been talk about whether maybe there'll be some sort of scaling up. They'll start kind of small and then accelerate over time. It's all speculation. I think we need to see the details, and that's why it's been so difficult, I think, for companies to plan and really think about how they're going to react until we see the details.
Well, we know the future Treasury Secretary thinks about tariffs, Scott Bessent. What I'm confused about is who's going to be the most hawkish in the administration, because the real tariff man, Mr. Lighthizer, Ambassador Lighthizer, is not joining Trump 2.0.
Yeah, that's absolutely right. And I think Scott Bessent yesterday in his confirmation hearing, clearly he's planning to pick up the mantle there. But, what I think is really interesting about the administration picks is that the economic team, and I'm talking Scott Bessent at Treasury, Howard Lutnick at Commerce, you can add in Paul Atkins at the SEC. These picks are really much more sort of mainstream than some of the extreme picks that we're seeing in other areas. And I think that's really reflective of how Donald Trump feels about the economy, feels about the markets. The one thing he doesn't want to happen is anything that damages the economy and damages the markets and sends the markets down. So I think here in Washington and I think on Wall Street, there's some level of comfort with these picks that they're going to be
Peter
thoughtful.
Navarro?
Peter Navarro, maybe not quite in that same category, but I do think generally that the most extreme picks seem to be in other areas of the government, and I think Wall Street is at least somewhat comforted by that.
Let's also discuss tax policy. Besson said yesterday it's the single most important economic issue of the day. This is pass-fail because there's a deadline. How do you see the process playing out on Capitol Hill?
Yeah, I think the process is going to be really, really complicated. And I've been saying to people all along that the thing to watch here is the House of Representatives. You've got what will effectively be a one-vote majority for Republicans. That basically gives every House Republican a veto, at least until special elections are held in April to fill a couple of the vacancies. So I think this is going to be incredibly complicated to keep all House Republicans on the same page. We've seen over the last couple of years that they really struggle staying on the same page. All that said, I do think the tax cuts, the expiring tax cuts, get extended by the end of the year. The real question is what else is added to that. Here in Washington, we're hearing a lot about no tax on tip income has some momentum. And then the other piece is how do you pay for it all? There are a lot of folks on the House Republican side who are really, really concerned about the debt and the deficit, and their vote is not guaranteed until the details are finalized.
That speaks to this idea, Michael, that the harder thing to work out is going to be taxes, is going to be the thing that the market has used to reignite the animal spirits. And instead, as you first started talking about, day one looks like it will be things like immigration and tariffs. In conversations with clients, how sanguine are they? Are they prepared for that reality that you're describing?
I think they're prepared. I think that, first of all, I think there's an assumption that the taxes that are expiring will get extended. But I think there's a lot of uncertainty about how big this gigantic bill can be. I mean, if you're going to put taxes and potentially the debt ceiling and government spending reductions and energy policy and you name it into one gigantic bill, the risk of that collapsing of its own weight is pretty high. So I think there's going to be a lot more twists and turns. This is not going to be a straight line to the tax cuts being extended. I also think it's going to take longer than a lot of people assume. The idea that it's going to get done here by late spring or something like that, I think that's a real stretch. I think we're going to be much farther into the year before this gigantic bill comes together.
Michael, what's going to be Elon Musk's role in all of this? Because we have seen a Musk, especially during confirmation hearings, who's been able to hold the idea that he will primary people who don't go along with Trump. He will donate to those that are running against them. Do you think that could act as sort of a stick in these negotiations as Trump tries to coalesce people together around one big, beautiful bill?
Oh, I think there's no question. What's the most important thing to these guys? Getting reelected. So they're always going to have that in mind. I think it's going to be really interesting to see how Elon Musk's role in the new government sort of unfolds over time. There's a lot of ego there. There's a lot of ego, obviously, with Donald Trump. Those two clashing at some point, I think, is all but a given. And, keep in mind that Elon Musk's role in this DOGE, the Department of Government Efficiency, doesn't have any actual power to do anything. It can only make recommendations. And once you get to recommendations for cuts, well, there's 435 members of Congress who have things going on in their district that they want to protect. And it gets much more complicated. So I think it's going to be one of the most interesting things of this first year of Trump 2.0 to see how the Elon Musk relationship pans out.
Michael, I think you're questioning how close they actually are. Do you think some distance will be put between Trump when he's in the Oval Office with Musk?
Yeah, well, obviously we'll have to see. We don't know. I just think these are two incredibly strong personalities, and that at some point, President Trump may get a little frustrated with Elon Musk's, time in the spotlight. But I do think that he sees him as a partner. I think he sees him as someone who has a long business experience of making hard decisions, and that's what Donald Trump thinks is needed to get spending down. So I think there's a chance that this works, but I think the chance of a flare-up is fairly high.
Hey, Michael, appreciate your opinion and perspective. Thank you, sir. Michael Townsend there of Charles Schwab. I know where you're going. Will Susie Wiles put some distance between them?
Well, I think so. And if you look at a recent interview she gave with the New York Times, she was talking about basically making sure that there is a process, that the staff that are promoted to do their jobs will be the ones carrying out. I think there would be a concern if you're, say, Marco Rubio, and Elon Musk is talking about German politics or Nigel Farage or China or Georgia Maloney and Starlink, they don't want every question at their press briefings to be about something Musk says, only because he has this proximity to power, which is the president.
Day one. Monday. Equity futures this Friday morning, and good morning to you. Positive by 0.4% on the S&P 500, supported this week by better than expected earnings coming from Wall Street. Better than expected data as well, a downside surprise on CPI, some dovish Fed speak, which ignited a bond market rally too. Bond yields are lower by more than 10 basis points on a 10-year. Yields this morning are down another 4. We're down to 4.57 on a 10-year yield. Up next on the program, we'll catch up with Norman Raw of CSIS with an Israel-Hamas ceasefire on track to begin on Sunday. From New York City, this is Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure. Don't miss Bloomberg's interview with the
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Equity futures right now. adding to the week's gains. We're up by a third of 1% on the S&P, call it 0.5 on the Nasdaq. Struggled to build on a three-day winning streak in yesterday's session, but we take back yesterday's losses already this morning, encouraged by the earnings, by the economic data, and some dovish Fed speak. With 2 hours until the opening bell, let's get you some morning movers. Here's Manus Cranny. Good morning, Manus.
Jonathan, good morning. Let's kick it off in the chip sector. Barclays note comes out. They talk about the sector and Broadcom. Broadcom, they raised the price target to 260, so a little bit above here. It originally was $205. They keep it as an overweight. They like the capital expenditure overall in the market. But here's the rub. When it comes to artificial intelligence, there are going to be the have and the have-nots. And this is where the struggle comes for Barclays. It's going to be tougher to get more positive on cyclical semiconductors, analog PC, and handsets. So they're questioning the strength of 2025, which then takes me into Apple. Bear this in mind, Apple was down 4% yesterday. Apple is down nearly 9% so far this month. They had a holiday season they would prefer to forget. So why focus on a stock barely up 0.7%? Because you're almost at a correction in Apple. Evercore pop it onto their tactical outperform list with a price target of 250. They are leaning into the fact that China remains the wild card. China, there you go. What will the tariffs be? What will the carve-outs be? What is your risk there? But you've got to lean into the iPhone 17 as another, perhaps being a little bit better than feared. But it just struck me, down nearly 9% so far in January is a pretty sizable change in price. JB Hunt slides, this is the transport company, down 9%. $1.53, way lighter than the market had estimated on earnings per share at 1.63. But it's the depth of the miss that Citi flag up for us. They're skeptical that you're going to see an inflection point in rates. And Bloomberg Intelligence have run their numbers. They reckon you're going to see a sequential EBIT decline of around 20 to 25% in this. Jonathan.
Manus, thank you, sir. Let's start getting hammered. Out of surveillance this morning, President-elect Donald Trump telling Senate Republicans he won't wait on them to implement policy. The Wall Street Journal reporting Trump has prepared roughly 100 executive orders saying he's ready to press the limits of presidential authority to go it alone on issues like immigration. The reporting from the Journal echoing what we've been reporting over the past week or so.
That's right. We're going to have about 100 executive orders in the first few days. I've heard all the quips from members of the incoming administration that his hand's going to start to hurt. He's going to need a number of Sharpie pens, which we know he likes to sign his signature with, in the 48, 72 hours. The issue is when it comes to certain policies that he wants to enact, he cannot go it alone. And I'm clearly thinking about the tax policy. TCJA, he talks about, was this historic legislation under Trump 1.0. You cannot extend that through executive order. He's going to have to play ball with Congress.
And of course, the issue with that, the things that he needs to play ball with Congress, the things that would take more time, be it taxes or deregulation, are the things that this market wants, are the things that presumably help lower inflation. You guys have talked about this so much around this desk, this idea that sequencing matters. If what we get first is tariffs and immigration, those are more inflationary policies, and you don't get the benefit of deregulation until sometime in the future.
That's why we keep saying we're encouraged by the news so far this week, but still nervous about what's going to come next week. Let's talk about a deal, the potential for a big deal. Rio Tinto and Glencore holding early-stage talks about combining their businesses in what would be the largest ever mining deal, rivaling long-standing industry giant BHP. Sources telling Bloomberg the discussions took place as recently as late 2024, but are not currently active. This is a potential deal we talked about a decade ago, and I'd make 2 points. One's on assets, and a second one's on culture. On assets, Rio Tinto's been trying to get out of the likes of coal. Glencore's been getting into it. In fact, I believe they took some Rio assets over the last number of years from Rio. Rio has been built on the iron ore boom and the construction boom in China. They've been trying to lean into things like copper. I understand that Glencore has the copper assets, and maybe that's what they're going for here, but then you involve culture. You start to think about a combination. I can't think of two more different cultures within a sector, Glencore versus Rio.
Just their history alone, right? Glencore starts as a swashbuckling trading commodity outlet in this Wild West. Rio Tinto had maybe a more classic start of miner, and I think that really imbues their cultures to begin with. M&A is always really, really difficult. Culture is always a problem. But this is a clash, I think, on epic proportions. So a lot of people looked at this deal and said, it makes sense that it fell apart because there's not a lot of logic to it.
That's before we even get into antitrust issues. But watch this space. Maybe it hasn't completely fallen apart, but pretty remarkable that that deal came back on a table after exploring the same thing about a decade ago. Let's turn to an important story. Israeli Prime Minister Benjamin Netanyahu saying a ceasefire agreement with Hamas is on track to begin on Sunday. His security cabinet saying this morning a hostage release also expected pending approvals. Bloomberg's Ollie Crook joins us now from Tel Aviv. Ollie, good morning, and what's the latest?
Yeah, so listen, John, even in the first 24 hours of this deal being announced on Wednesday night, there were some stumbling blocks between the Israeli government and Hamas leadership. Those seem to have been resolved this morning. Where this sits this morning is with the security cabinet. They have been meeting now for over 4 hours, and this is trying to get approval from the Israeli government to put this ceasefire deal into action. The difficulty that the government is going to have here is that Benjamin Netanyahu's party has been supported by a number of right-wing parties here who have in fact threatened to leave the coalition government if they pass this deal through, because they want to continue to prosecute the war until basically the entire eradication of Hamas. It seems that even if they were going to do that, that they could still pass this deal with a minority government. Plus, there is so much will within the Israeli population. You get off the plane here, it's the first thing you see at the airport, the posters of all the hostages that are led. There are stickers all over town. There is huge, immense will to get this over the line. And if you do get it over the line through the security cabinet and then the cabinet vote a little bit later today, you will get that first exchange of hostages. That ceasefire will take place on Sunday for 6 weeks. You will get 3 female hostages, a total of 33 to be distributed over that 6-week period. In return for that, you will begin to have the prisoner released from the Israeli side that are held the Palestinians. And really what you're going to get also is, of course, a cessation of fighting within Gaza and a withdrawal of Israeli troops, not out of Gaza, but down the eastern corridor. And critically, John, the other sort of element here, more than 45,000 people have been killed so far in Gaza. The infrastructure is completely shot. This will allow huge volumes of aid to finally pour back into Gaza, which is in desperate need of that at the moment right now.
Oliver, let's talk about the hostages. I'm told 24 of the 33 are alive, and I'm told about 9 or 10 of them are in either wounded, seriously wounded, or ill. Like, the conditions these individuals are going to come out in is not going to be good. At what point can we see all of the hostages be freed from Gaza?
So listen, so let's talk about the sequencing here. What we're going to get in the first wave here are going to be the release of mostly women, elderly, and wounded. It is very hard to appraise at this time how many of the hostages are still alive, how many of it is going to be the corpses that are being returned to Israel. In terms of the sequencing, there are 98 hostages that remain. 33 will be sort of released in this first part of the ceasefire agreement. But remember, this is an agreement that has 3 parts by the sort of architects of this that brokered the deal, Qatar, the United States, and Egypt. What they would like to do is, after this sort of first phase, is to go further into the second phase, but that is going to be basically what Biden has called the actual end of this war. As difficult as it has been to get to phase 1 here, we've been in this war for more than 400 days, more than a year and 3 months. It is actually going to probably be harder to get past phase 1 into phase 2, despite the fact that by the brokers of this deal is supposed to be not just a ceasefire for 6 weeks. This is supposed to be the architecture of the end of the war. What this will now open, though, are the very, very challenging questions that are really at the heart of this conflict, not just for the last year and a half, but for the last decades. Who is going to oversee security over Gaza? Who is going to ensure that there is a government there that both represents the people of the Palestinians and Gaza, while also sort of preserving the Israeli guarantees? That is really at the heart of the question here as to whether or not there's going to be any more progress past this first phase.
Ollie, appreciate the update. Thank you, sir. Bloomberg's Oliver Crook in Tel Aviv. Elsewhere, former senior U.S. intelligence official Norman Rule writing the following: the execution of the agreement will likely take longer than the 4 months described in the deal, with opponents among the Israelis and Palestinians who must be managed to ensure the agreement doesn't collapse. Norm joins us now for more. Norm, as always, a great deal of amount of respect for your perspective and your opinion on the matter. Could you just share with us whether you think this agreement will hold, it won't collapse?
Good morning. It is very likely to hold and to take place. The deal is a cause for celebration by the families of the 24 hostages will be released, and will bring some element of closure as the remains of 9 other hostages are returned to their families. But importantly, the Palestinians see an end to violence, so they will be able to begin a very long road to reconstruct their lives. So there's drivers on each side for this initial deal to take place. But in the longer term, moving to the second phase, as you discussed in your previous segment, it's challenging. And because all hostage deals come with cost. Hamas and Hezbollah are no longer strategic threats, but sufficient elements of each organization remain that can be rebuilt, and Iran hopes to do exactly that. Israel's about to release hundreds of prisoners, many of whom were convicted of serious terrorism crimes. Some of them will return to terrorism. Israel reportedly is also about to release some settlers who are convicted of anti-Palestinian violence, and that will create trouble. So in many ways, what we're watching is relief, a good first step, but a beginning of a very long road. And importantly, the Trump administration, which played a huge role in the success, will now need an architecture to manage and sustain this momentum.
Well, let's talk about the Trump administration. The incoming officials, Steve Witkoff, Morgan Ortagus, were brought into helping get this deal over the finish line, working alongside the likes of Brett McGurk, who's basically been camping out, Norm, in Doha, working on the framework. Who do you think gets the credit for putting this over the finish line?
Well, everyone does, but there's a formula by which this succeeded. First, you had significant work by diplomats on all sides to develop a framework. But that framework was unlikely to have been executed under the Biden administration had it not been for Israel's destruction of Hamas and Hezbollah leadership, which the Biden administration often publicly opposed in terms of the operations. But even then, it is unlikely this would have happened without President-elect Trump's profoundly hard statements, his involvement in the process, and sending Steve Witkoff, who, according to many reports, has been masterful in his handling of both the Palestinians and the Israelis. So there's a formula here that required all three pieces to make this a success.
What about the remaining hostages, not the 33 that are going to be released starting on Sunday? Do you think Steve Witkoff and the incoming Trump administration can get those remaining hostages out of Gaza?
It's a possibility, but again, we're looking at the second phase of this deal. That's going to be hostage to elements in the Israeli right who, even if they agree to the first phase, do so only because there's a belief that the second phase will involve further military operations to destroy Hamas. It also involves Hamas not undertaking kinetic operations against Israel, and there are multiple violent actors within the remaining Hamas organization who are likely to do so. So it's going to be a challenge. It's going to take a lot longer than I think some people perceive, and it's going to, again, be critical that we have a system and a team to keep this pressure on all sides.
And Norm, even beyond that, there is still no clarity in who runs Gaza once we get through these different phases. Netanyahu hasn't presented any type of plan. There's clearly no appetite to allow Hamas to continue to run the Gaza Strip. What is a possible alternative for this region?
There are no possible alternatives that are seen at this time. The good news is Israel is demonstrating it wishes to withdraw from the Gaza Strip. It does not seek to occupy this permanently. The bad news is Hamas fighters remain in their thousands. They're disorganized. They lack leadership, but they have the guns. They're going to want to control the aid and its distribution. So who pushes back on these Hamas fighters and the criminal gangs, which have hijacked a fair amount of aid in recent months, is not only an open question, but we actually have part of the answer. There isn't anyone yet there to do that. And that opens the prospect of Hamas reconstituting itself and this process, in essence, beginning all over again in the long term.
Norman, I mean, is it just fair to say, though, that this conflict is just far from over, years from being over even?
Absolutely. This will require, ending this conflict will require, first, the Israelis agreeing to a two-state solution, but also the Palestinians demonstrating that that two-state solution won't leave Hamas in charge of that state, not only against on the borders of Israel, but on the borders of Jordan. And the Palestinian Authority has been a relatively sidelined element in this entire negotiating process, and they have not demonstrated they have the capacity yet to provide security and the governance that Gaza needs. If an election took place today in the West Bank and Gaza, Hamas is likely going to be the winner.
Norman, appreciate your perspective, sir, as always, and your time. Thank you. Norman Rule there of CSIS. Let's get you an update on stories elsewhere this morning. Here is your Bloomberg brief, and let's kick it off where we left off. Yemen-based Houthis signaling a pause in attacks on commercial ships following the Israel-Hamas ceasefire deal. The Houthis leader saying they will follow the agreement, but leaving the door open for resuming attacks. Elsewhere, New York City Mayor Eric Adams meeting with President-elect Donald Trump in Mar-a-Lago today. Differing from many in his party, the mayor expressing support in deporting violent criminals and cooperating with federal law enforcement on immigration. And finally, Citi cutting more jobs this week. People familiar with the matter telling Bloomberg managing directors in the wealth business and technology unit are leaving. The bank also cutting a data team. The reductions come as part of CEO Jane Fraser's push to cut costs. That right there is your Bloomberg Brief, and that is not the only time we've seen a story like that. Over the past week, how much longer can we sit here and just say, well, that's idiosyncratic, that's city-specific, that's Wells-specific, that's JP Morgan-specific?
Slew of stories, and not just in the banking sector. Meta, Microsoft, we've seen a number of companies come out and say, we are actually going to trim some of our workforce.
It's not even just cutting jobs, it's taking away benefits. Citi already lowered 401k. Things like, I mean, finally, pet leave apparently was a thing, is getting taken away too. It's not just outright firing people, but it's kind of saying...
Hold up. I didn't know pet leave was a thing.
There was a Wall Street Journal story that apparently pet leave was a thing at some companies, and they're finally taking it away.
This is what happens when HR is running companies and not founders.
So what happens? I have to get a dog and then I can have a day off?
Yeah, it's like paternity leave.
That's actually a thing?
Yeah, apparently some companies
when you first get a puppy, you can take time off.
Or if your dog or cat or, I don't know, dragon gets sick. Hamster, you could take time off and make sure you're there to hold its paw at the vet.
I'm getting a hamster this weekend, and I'm going to take the next 3 months off.
I thought you were going to get a little French bulldog.
How long do you get off? Just out of interest.
I don't know.
Who's doing this? Where do I sign up?
I mean, taking care of a puppy is hard work, I guess. I don't know. I guess we'll see you in a month, John. Good luck with your hamster.
Up next on the program, TikTok's 11th hour.
We'll either close up TikTok in this country for security reasons, or it'll be sold. We did go on TikTok, and we had a great response with billions of views. They said, maybe we got to keep this sucker around a little while.
That conversation up next, live from New York. You're watching Bloomberg Surveillance.
I've seen firsthand how some fashion businesses make women feel. And I think there's one thing, you know, being really vocal and being an Instagram activist and talking about something, there's a difference than putting your money where your mouth is and really trying to do something about the problem. And that's what I did with that business. It was about how do I take everything that I know and I've learned and actually do the opposite. And I think that as a young black female entrepreneur, the only thing that I could do was what I know from my experience. And the honest truth is, I didn't set out to create a company that was like deeply rooted in the principles of inclusivity and diversity. I set out to make a company that was right for me and my friends, and I knew that if I had a problem, chances are somebody else does. And I think that's where so many businesses are, you know, created, when you're solving a problem that's real for you and therefore real for the consumer.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. markets close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live every trading day. Balance of Power, live around the world, only on Bloomberg.
live from New York City. Welcome to the program. If you are just joining us, stocks higher by 1/3% on the S&P 500. Bonds rallying once again. Yields lower by 3 basis points this time. The 10-year 458.24. Under surveillance this morning, TikTok's 11th hour.
We'll either close up TikTok in this country for security reasons, or it'll be sold.
I have a warm spot in my heart for TikTok because I won youth by 34 points. And there are those that say that TikTok has something to do with that. We did go on TikTok, and we had a great response with billions of views. They said, maybe we got to keep this sucker around a little while.
So here's the latest this morning. A Supreme Court ruling expected today on TikTok's ban in the United States. The app is facing a Sunday deadline to find a buyer. The Washington Post reporting President-elect Donald Trump is considering an executive order to delay the ban. Mark Kelly of Stifel writing this: if the ban is enacted without reversal, we see Meta, Alphabet and Snap as the biggest beneficiaries. We'd expect Meta with Reels and Alphabet with YouTube Shorts to receive the majority of reallocated ad dollars. Mark joins us now for more. Mark, welcome to the program. There are the potential consequences. What's your base case for what happens later today from the Supreme Court and this Sunday?
Good morning. Thanks for having me. My base case is that this gets pushed out again. And we're seeing that on both sides of the aisle. So you've got, Senator Ed Markey in Massachusetts, who's been trying to push for an extension, and now we're seeing it from the Biden administration as well. So I think it gets pushed out again. And frankly, that's what we've been hearing from the advertising community, is that overall, no one was really expecting a ban, to take effect.
When it comes to the Supreme Court, and you think your base case, they will likely uphold the law, do you think it's changed, given some of the politics have changed in the last even just 48 hours?
Yeah, I think, honestly, my base case before Friday, when that TikTok hearing didn't go well for TikTok, my base case was that the platform would not be banned. And I say that because, a lot of folks talk about the, security threat that, TikTok perhaps poses. I would say, if it was such a big threat, I would hope our government wouldn't let TikTok kind of operate as is through the election for such a long period of time. So, I wonder what that threat is. I'm not saying that it isn't a threat. It just having more clarity, would be important, I think.
So what happens now in terms of who could potentially take this company over? What do you make of reporting? We've had a scoop here at Bloomberg that Chinese officials are looking at potentially Elon Musk as being the #1 choice to run this company.
Yeah, I think, what's important with any divestiture is what comes with, the TikTok business. ByteDance has been very clear that they will not part ways or give parts of the algorithm to a potential buyer. So, it begs the question, what are you actually buying? You're buying 170 million, roughly, U.S. users. You're buying the shell of an app, but you really don't have, the algorithm and the tech in the background to power that platform. So Elon Musk as a suggestion does make some sense to me, given what he's done with Twitter and X. And I think if he was the acquirer, I think he's, well equipped to handle whatever situation is thrown at him.
Well, Mark, part of the reason that TikTok's not going to go dark on Sunday is because President Biden has said that he won't enforce the ban and he'll leave it to the Trump administration. But literally on everything else, when it comes to Cuba sanctions, when it comes to Russia sanctions, various laws, the Biden administration has shown a willingness to do things in the final days until President Trump takes over. Why do you think on this one issue, it's something that Biden has decided to pass along?
I'm not a political analyst, so I don't want to get too deep in the weeds there. But I do think, again, both sides of the aisle, throughout the election cycle, everyone up for re-election had a presence on TikTok, while also saying that it poses a national security threat. Yes, you highlighted at the outset, that Trump did well with younger users, particularly men, I think, on TikTok. But so did the other, side of the house as well. So I do think a lot of what we heard on Capitol Hill was probably a lot of posturing, last year when they called the TikTok CEO in front of Congress a couple different times. I think a lot of grandstanding there. And at the end of the day, I think we all kind of need to know, what is this national security threat, if it is an actual security threat. So I think throughout this whole process, there have been, support and also folks that are very skeptical of TikTok, again, on both parties.
Mark, just before you go, I'd love your comments, your thoughts on the Zuckerberg conversion. Turning up to the inauguration on Monday, changing the way they censor, stripping out the liberal bias from maybe the way they operate on the West Coast. Mark, do you think it's going to drive engagement? Will it push up ad dollars?
For Meta, you know, I think if we use the election as a proxy for what the overwhelming majority of folks in this country prefer, I think they would like some unfiltered news and community notes. You know, I've been on X quite a bit. I would say, in my opinion, community notes look like they're working pretty well. So if it works as well on Facebook and Instagram, I think that's great. I do think Meta's probably, I don't want to say worried, that's not the right word, but they want to make sure that the advertising environment is a good one, where people feel comfortable that the content isn't offensive, it aligns with your brand. And they have a couple third-party partners, Double Verify and Integral Ad Science, that they partner with to give people some of that comfort. And there's a product in particular that Meta was slated to come out at the end of this year that they actually brought forward to essentially Q1 of this year. So I think, to me, that tells me that Meta has been contemplating this move, particularly on the content moderation side for a bit, and brought in those partners a little bit earlier.
Hey, Mark, appreciate your time and your opinion. Thank you, sir. Mark Kelly there of Stifel. The latest on TikTok, we should hear from the Supreme Court potentially later on this morning. Up next, in the third hour of Bloomberg Surveillance, we'll catch up with Jim Carrot of Morgan Stanley, Jason Bazinet of Citi, looking ahead to Netflix results, Steve Rasciuto of Mizuho, why he thinks no rate cuts in 2025, even with that CPI print earlier this week. And we'll get the thoughts of Phil Camprelli of JP Morgan Asset Management on the latest in this market. The latest right now, equity futures positive on the S&P by a third of 1% from New York. You're watching Bloomberg TV.
In 2000, post-Napster, generally everybody wrote off the recorded music industry, including the investment community. And I didn't mind that chapter because then I got left alone. And actually, I think out of that period, we started to create better art because the pressure wasn't on from the technology to be the most powerful chapter. And then iTunes came in, and iTunes, to Apple's credit, did have a boutique taste mentality about the store, which meant that I think they understood. I can tell you from that period that the artists that came through were of a very high quality because it was encouraged to be boutique. Now, ironically, this chapter has made us more money times 5 than the iTunes chapter and the post-Napster chapter. But an algorithm tells you what you want, not what you might like. And there's a difference between what you want, but with streaming, the downside is you have incredible penetration, and we have hundreds of millions of people around the world. And so that has been very lucrative as a business.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
What about artificial intelligence? Is artificial intelligence going to enable you and others to say, we have enough information to know exactly what something is going to be worth in terms of insuring it or not?
Artificial intelligence is finding its way into our business in a variety of different factors. I think the first piece is getting much better insight into data, which allows us to make better decisions on underwriting. It's also a great opportunity to service business better in terms of like call centers and different ways of what's using robotics and other AI will be very helpful. But it is an emerging practice within the industry, and one that is evolving very quickly. So it's also going to present risks that other companies, how they use it and how they use large language models, and making sure the decision making is very sound. So it's complicated, but it definitely is benefiting the business today.
Jumpstart
Kickstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
Markets pricing in just the right stuff coming out of D.C.
We've always viewed policy as either an accelerant or a dampener. By itself, it rarely makes trend.
The engine of the car, being the consumer, looks completely fine. Is it going to get turbocharged by some of these policies? I think that that's probably a risk that we can't dismiss.
We're in this really sensitive period of time right now. The markets are really walking on pins and needles.
There are these exogenous shocks that are going to disrupt the cycle that we're currently in. We don't know the probability and we don't know the size of them, but we know that they are coming.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
So technically it's a long weekend stateside, but on Monday, a lot of people on Wall Street will be at work. It is day one of the Trump presidency just around the corner. Equity futures going into the weekend positive by 0.4% on the S&P 500, poised for the first weekly gain of the year so far in 2025 on the S&P 500. On the Nasdaq, up by 0.5, on a Russell, up by 0.6. In the bond market, yields down once again. For the longest daily streak, going all the way back to early December, we're down another 4 on a 10-year. We're down 5 on 30s, encouraged not just by the economic data, but also by a very dovish Governor Waller.
Governor Waller saying yesterday that there is a potential, if the data continues as it has been, to get a cut in the first half of the year. That is quite the low bar. We've been saying the CPI ended up coming in lower than expectations by 0.002%. The market has taken it in stride, even though Waller does sound like an outlier, even though there's this idea that he's campaigning for Fed chair. But John, I go back to the idea that both can be true. He can be a dove, and he can be hoping that he gets the next chairmanship.
If the data allows them. Frances Donald, RBC, sat around this table yesterday. You heard from her just moments ago. She thinks the data won't. And she thinks the policy changes you're about to see will keep this economy running hot, and maybe with an inflationary impulse, which will keep this Federal Reserve on the back foot.
And we've seen the market price in Trump 2.0 at the start after the election, but even for some firms, it's been before the election. They thought he was going to win, and people put these bets on. Next week, we can actually see what sticks from the policy proposals we've heard on the campaign trail, and that is when we are going to get a slew of executive orders over the first 48 and 72 hours, and then also potentially all these stories about these competing narratives on tariffs. What gets presented to the president, and what does he decide on?
Coming up this hour, Jim Karen of Morgan Stanley. As this equity rally takes just a little bit of a breather, Jason Bazinet of Citi looking ahead to Netflix earnings, and Steve Rasciuto of Mizuho on why he sees no chance of rate cuts through 2025. We begin this hour with stock steady, investors pausing ahead of President-elect Donald Trump's inauguration. Jim Karen of Morgan Stanley saying, ask not why yields are rising, but why the yield curve is steepening. Context matters. There is no magic level, but when yields stop rising and plateau at a level that competes with equity returns, this is substantive, but yields need to stop rising first. Jim joins us now for more. Jim, a few days of it. Are you confident enough that we have stopped rising?
No, I'm not. I actually think that we're going to be in a range. I think the range is probably 4.25% on the 10-year up to 4.75%. And I think that we can overshoot a little bit to the upside. I mean, I don't think 5% is out of the question. And now the way that we start to think about this is it goes back to the yield curve. And the big debate is, does the Fed cut 0 times, 1 time, or 2 times? But nobody's talking about hikes, and that's really the good news. So if we think that the slope between the 2-year note and the 10-year Treasury, if we think about that spread, if that spread is going to be somewhere more normalized, let's say 50 basis points or 75 basis points, then if the Fed funds rate stops at, say, 4.25%, if you have a normal sloped yield curve, you could have a 10-year note that's around 4.75 to 5%. I don't think that's bad news. If it's because the economy is growing and we're getting decent, we have relatively low inflation, so you're getting higher productive growth, then a steep yield curve, those bond yields are perfectly acceptable and manageable by the equity markets.
Jim, just hold on to that thought. I just wanted to jump in with a breaking news headline that we've been waiting for. A lot of people anticipating this, getting some confirmation. The Israel Security Cabinet has approved the Gaza ceasefire deal. Just some confirmation there that the Israel Security Cabinet has approved the Gaza ceasefire deal. We'll bring you some more updates a little bit later in the program. Jim, I want to return to the bond market with you once again. Jim, you were talking about the slope of the yield curve, and I'm with you, and I just want to build on it. And for people who might have missed it, the 2 years basically anchored around where the Fed funds is at the moment. So if you're anticipating no real action from the Fed through the next 12 months, 24 months, that makes sense. And then if you're just to add them another 40, 50 basis points through the curve, just some normal steepness, you can make the argument for where we are, absent fiscal concerns. And Jim, that's what I wanted to come to you on. Is there any evidence whatsoever that at the longer end of the curve, we've started to price in some kind of fiscal premium with the incoming administration?
Yeah, we are pricing that in, and this is what people refer to as term premia. The government, the incoming Trump administration, I should say, is likely to run some positive fiscal expansionary policies, meaning that they're going to likely deregulate and they're looking to cut taxes. Both of those things I will call fiscal policy and in thinking about it as expansionary. However, what they're also trying to do is reduce the deficit. Can you do all three of those things? That's the key question. Now, Trump has put in place the DOGE, right, the Department of Government Expenses and Expenditures, and he is looking to reduce some of those government expenses. What we have to remember is that inflation is driven by government outlays. The government outlays in 2024 was over 10%. That is a significant amount of number. It's a big contributor to inflation and inflation risk. If that starts to come down, as Trump is promising that it should, and if it does, then you should have a lower inflation impulse. So you can run expansionary fiscal policy and not have to pay the price of higher inflation. Now, that's the trifecta, effectively. Now, we need to see if that's going to work. But essentially, if the market starts to price this in, and this is an out of consensus view, if the market prices it in, that's really positive for equities, and it could actually be positive for credit spreads and bonds too.
And Jim, that makes a whole lot of sense, but how we're likely to get policy from Trump, given the first time around, given the hints that we've gotten going into his inauguration, isn't even. It's an unpredictable one with often varying parties jockeying to have the influence of Donald Trump. Does that not in itself argue that you're not going to see that plateau in yields that equities need, that there's going to be more volatility, which might in turn hurt risk assets?
Yeah, that's exactly right. I'm glad you brought that point up, because effectively what that generates is a higher risk premium or term premium. So the market's saying, look, I hear what you're saying and I hear what you're trying to do. However, we're a little bit skeptical, and that's building in some of that inflation impulse. And that's one of the reasons why the yield curve is likely to continue to steepen this year until we see this really manifest and come through. So it's not really a done deal at the moment. Look, tariffs is the other thing that's being discussed as well. Is that inflationary, or are tariffs a tax, a one-off price increase? Does it create substitution effects, and does it actually bring down inflation? Depends. It depends on how it's enforced and how it's enacted and how targeted it is. So really the critical element here is to see what Trump actually does in his first, several days, but certainly the first 100 days. And this is what the market is wrestling with right now. And it's built in a little bit more term premium, steepness of the curve, and that's pushed back end yields higher. What
does that mean for cross-asset allocation, Jim? Can you build a portfolio where bonds can have negative correlations to equities that can act as a hedge this year?
So, this is a point that's near and dear to me. Right now, bond returns are very high. They're at all-time highs, highly correlated relative to equities. I go back 110 years on this data. So it is going to be really difficult to build in a portfolio that's very, very well diversified, meaning that if I own bonds, it's a good hedge to equities. If you're passive, it won't be. But if you actively manage your fixed income, if you actively manage your equities, if you're very selective about the investments, about the assets, if you think about the broader parts of the markets like mid caps, where there could be more earnings potential growth and things like that, if you build that into your portfolio, then yes, you can have a diversified portfolio. But if you just go passive bonds, passive equities, they're going to be highly correlated, and you're not going to get the diversification benefits. Bonds will not be as good of a hedge. So you need to be very active and very selective in terms of what you're building in. And if you do, it's a great opportunity.
Jim, just before you go, just on our radar, we wanted your thoughts on Europe. Things are starting to happen. Early days, I know, but some outperformance in European equities. We saw that in Paris, France yesterday off the back of the luxury players. Seen it continue throughout the week. Euro Stoxx 50's had a nice 4-day run. Too early to say whether we're sort of breaking the trend, breaking expectations that we came into 2025 with.
Yeah, don't look now, but Europe's outperforming the U.S., and I think it's very important to highlight that. Why is that the case? In my view, why that's the case, this is part of our cyclical view. Cyclical's doing better in 2025. Effectively, PMIs, manufacturing sectors, have been in a recession essentially for the past 3 years. Europe is very highly levered to their equity market is highly levered to a cyclical recovery in manufacturing because that generates a lot of their GDP. And I think the European markets are picking that up, especially European financials. We still like that segment of the market right now, but we may expand more into the industrial and manufacturing base. But this is still a very, very good opportunity to diversify your portfolio. Think global. It's not just about the U.S.
Jim, appreciate your time. Jim Caron there of Morgan Stanley. Finishing up on Europe. We saw a record high on a FTSE. Danny, you pointed this out earlier. We've seen that repeatedly, actually, over the last year on the DAX. The DAX had a great 2024, despite people being very downbeat on Europe. It's January 17th. I want to be very careful, the kind of questions I ask, but could this be the surprise of 2025?
I mean, so many people got down on Europe and said U.S. exceptionalism, it's the only thing you could buy. I think the one note of caution is when you look at the things that are performing, DAX and FTSE 100, it's very, very global businesses, and it's businesses that are very exposed to the U.S. This is where the tariff threat comes back into play. That Monday will also matter for these markets that have just started to hit all-time highs too.
Stocks up nicely over in Europe, up nicely here stateside too, just not as much. We're up by 0.5% on the S&P 500. Moments ago, some breaking news out of Israel. So let's head over to Tel Aviv and catch up with Bloomberg's Ollie Crook. Ollie, what have you got?
Yeah, so Jonathan, we just got the approval from the Security Cabinet that they will move forward with this ceasefire agreement. This is where the debate had been sort of stuck here in Israel for the last sort of 4 or 5 hours, being debated at the highest level of the government. This now will move on to the next phase of this, which is the full cabinet approval. So we got this statement from the Prime Minister's office that's saying that after examining all political, security, and humanitarian aspects, and with the understanding that the proposed deal supports the achievement of the war's goals, they've approved it. Now, that is a very important line there, Jonathan, because there has been a lot of debate within this government, particularly from the right wing, who did not want to enter into a ceasefire agreement, saying that basically this will only allow Hamas to regroup and that they wanted to pursue this war and basically wipe out Hamas entirely. This leaves the door open very clearly, and this is something that has been won by the sort of far right, in order to continue to sort of re-prosecute this war after the 6-week period. So this is going to be the sort of intense debate within Israeli politics right now. But under the pressure that we've had just on the streets here, there have been protests basically against the government here, basically saying that you need to bring these hostages back. Under that pressure, this has been approved by the Security Cabinet. Now it goes to Cabinet, and we can expect this to be put into force, the ceasefire for 6 weeks on Sunday.
Oliver, also under the pressure of Donald Trump and Steve Witkoff, that is what really brought Netanyahu to the table. According to third-party officials in the region I've spoken to, it was Witkoff that really did a lot of this heavy lifting. When it comes to the hostages, now that we've had this approval from Israeli Security Cabinet, when will the first hostage be released, and what is that process going to look like?
Yeah, so I can give you a little bit of the mechanics of what that's going to look like. What we understand so far is that this is going to be done in several phases. So the first phase will be 3 female hostages will be released on Sunday. In exchange for that, there will be Palestinian prisoners that will be released by the Israelis. And basically, over the sort of ensuing 3 or 4 days, every three or four days, you'll have 3 or 4 hostages released. And then you'll have the same thing on the other side from the sort of Palestinian prisoners. We understand that there are going to be sort of 33 in this first phase of this agreement. We also understand that that will mean hundreds, if not more than 1,000 Palestinian prisoners to be released. What this will also guarantee is obviously ceasing of the fighting within Gaza, but also a beginning of a withdrawal of Israeli troops, not from the Gaza Strip, but from the populated area so they can go occupy the sort of eastern corridor of Gaza. And of course, the other critical point here is that this will allow a lot more aid to finally flow back into Gaza after, 45,000 people have been killed and all of the infrastructure and all the supplies really decimated over these last year and 3 months.
Ollie, appreciate the update. Thank you, sir. Bloomberg's Ollie Crook in Tel Aviv, Israel. Let's get you an update on stories elsewhere this morning. Here is your Bloomberg brief. Happening just moments ago, Israel's Security Cabinet approving the Gaza ceasefire deal. The deal expected to start on Sunday. It includes Hamas releasing 33 hostages, Israel withdrawing troops from populated areas, and freeing around 1,000 Palestinian prisoners. Elsewhere, former central banker Mark Carney announcing a bid to replace Justin Trudeau as head of Canada's Liberal Party. Carney said he's focusing on politics and has resigned all of his corporate roles, including as chair of Bloomberg Inc. And I can tell you just seconds ago, Anne-Marie Chrystia Freeland, the former finance minister of Trudeau, saying she's running to be the Liberal leader.
Not surprised. It was about a month ago that she decided to resign, and that is when Trudeau faced his biggest test, and he was really forced to step aside because of that scathing letter she wrote, Jonathan.
20 points behind the Conservatives in the polls. They've got a very steep hill to climb. And just finally, Los Angeles Dodgers superstar Shohei Ohtani is donating $500,000 to those forced to flee the wildfires. The Dodgers and other allied sports teams are selling LA Strong shirts, with all proceeds benefiting the LA Fire Department Foundation and Red Cross. That is your Bloomberg Brief. Up next, the Morning Calls Plus. Jason Bazinet of Citi ahead of Netflix earnings. That'll be next. You're watching Bloomberg Surveillance.
There is this real momentum from Wall Street. We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
US tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
The opening bell 1 hour and 13 minutes away. Equity futures on the S&P 500 positive. Once again, a lift by 0.6%. Let's get you some morning calls. First up, Evercore ISI adding Apple to its tactical outperform list, citing continued growth in emerging markets and strength in wearables. That stock is up by 0.9%. As Manus pointed out earlier, though, some real weakness so far year to date on Apple. Your second call from TD Cowen upgrading Salesforce to buy, saying its recent pullback has created a compelling entry point. That stock is up by 0.25%. And finally, Bank of America downgrading Southwest to underperform, citing execution risk in its product offerings. Let's turn to streaming. Investors bracing for Netflix earnings out on Tuesday. The majority of Wall Street is bullish on the streaming giant. But Jason Bazinet of Citi is neutral on the stock, writing, "We expected to report net additions ahead of sell-side estimates. We like Netflix's strategy and execution, but we don't see material upside at prevailing levels." Jason joins us now for more. Jason, welcome to the show, sir. Good to hear from you as always. What's ultimately behind that call? You're not impressed by the content slate? What is it?
No, I'm impressed by the content slate. I just think the valuation reflects a tremendous amount of good news. I mean, going into this quarter, people expect great net adds. They're excited about the content slate. Netflix continues to be the undisputed winner in streaming. And all of that is reflected in the stock. I mean, it's trading at 28 times 2026 earnings. That's a pretty full multiple, especially because top-line growth, we think, will begin to decelerate as we move into 25, 26, and 27.
Jason, there's also been a lot of excitement around Netflix on live sports streaming. They spent an immense amount of money over Christmas getting the NFL rights, having Beyonce perform at a halftime, to a lot of accolade. But at what point did the expenses start to pay off? How do you justify the spend that they're having? Not to mention, it might get more expensive as the Amazons of the world also look at what they're doing and already have to some degree, want to get involved.
Yeah, I think there's a little bit of a misunderstanding among generalists about sports. The reason I say that is Netflix will clearly move into sports. It will be very expensive. What people tend to understand is that the sports rights costs essentially is sort of matched by essentially the advertising revenue that you get. So once Netflix stands up a full-throated ad streaming service, the only way you can make this work is if you end up getting more subs. And in the US, of course, Netflix is already quite penetrated. So I'm not as excited. I think going into sports is a smart strategy for Netflix. I'm less convinced that it's actually needle moving in terms of helping the firm grow earnings.
When it comes to getting more subscribers, and especially on that ad bracket, Jason, it was last year that a lot of executives, there's some FT reporting about this, that Netflix was cheaped, that Amazon was starting to price itself more cheaply than Netflix for people coming in and buying ads. What does that market look like right now? Is there a race to the bottom, and at least at this beginning stage, trying to get advertisers onto the platform?
I would not characterize it as a race to the bottom. I think what ended up happening is because Amazon essentially forced all of the Prime customers onto the ad tier unless you opted out, it ended up causing a supply-demand imbalance for sort of digital advertising. I fully expect that we will reach equilibrium and that pricing for ads will continue to march up. But I don't think this is a race to the bottom, and that's good for Netflix.
What about price hikes when it comes to wanting to engage in whether it's any other streaming service, but also Netflix? Can they have the ability right now in 2025 to raise prices?
Well, it's very interesting. Remember, the company has already guided to 2025 revenues. And they've said that the way to get there is relatively balanced between subscriber growth and pricing. What the buy side has been waiting for is for Netflix to announce a U.S. price hike. Many expected in the third quarter, many expected in the fourth quarter. And there are elevated expectations that if they don't announce it, at least on this earnings call, that shortly after earnings, they announce a U.S. price hike. And Netflix's view is that they take those price hikes when they can earn it. There's been modest improvement in the level of engagement on Netflix. And so I fully expect that they will take a price hike. If they don't, if something goes wrong, then I don't think it's going to be possible for Netflix to hit the 2025 revenue guidance that they've articulated.
I love how you broke this down in your research. U.S. consumers pay $0.006 per minute for Netflix, very similar to what they pay for television. But why do you think they're waiting so long, if they have the customer base and they're doing well, to hike prices?
Well, it's interesting. When you ask Netflix this question, they say that they don't look at the price of linear TV as a competitor. Having said that, when you go back over time, U.S. consumers are paying exactly the same for Netflix per minute as they are for linear TV. Netflix, of course, is much cheaper than linear TV, but it's about the same price. And I think it's sort of a guardrail, maybe is the way to think about it, that Netflix can't get price too expensive and get that price per minute too high. And so part of their push to move into sports, part of the excitement they have around the content slate is to get that engagement up to earn the right to take pricing up. But the dollar per minute may stay relatively flat.
Jason, I am just hearing a lot of skepticism from you. I know you're not outright bearish on the stock, but as we started this out, you're not sure they can reach the level that is currently priced in. Could you be surprised? Do you think that there is any potential here, or is it just like skepticism all the way across the board?
No, there's not skepticism. My only point is a price hike is embedded in the expectations. And so if they deliver that, I don't think it's a beat. I don't think it causes outsized performance in the equity. They need to announce a U.S. price hike to sort of hit their guidance for the year. It's not bearishness. It's just recognizing a lot of good news is priced into the stock. They have to deliver 13 million net adds. The company sort of said we're going to do better than last quarter, which was 5 million. That's heightened expectations. They have to deliver a U.S. price hike to hit the guidance. That's heightened expectations. The multiple, I think, is relatively full. So I'm just trying to find opportunities where we can make our clients, huge amounts of upside. And I just don't see it in Netflix. I love the company. I love the strategy. I'm just not sure it's a stock that's going to outperform.
Jason, just quickly before you go, can we talk about content? Very briefly, Landman, Paramount, absolutely love it. I'm just wondering how much more of this we're going to see, sort of pro-rural America, pro-conservative content like Landman.
Yeah, I think you're probably going to see more of that. I mean, we have seen sort of, the middle of America sort of underserved from a content perspective for a number of years. And so there is white space out there for Hollywood to capture. And I think the response function, as these shows get a good viewership, will I think sort of cause Hollywood to readjust and serve middle America and red state content, for lack of a better word.
It's happening. Jason, appreciate it. Thank you, sir. Jason Patterson there of City on the latest with Netflix. You watched any of this?
I haven't, but the lineup, the cast is
pretty
incredible.
Amazing.
Yeah, Demi Moore, John Hamm, Billy Bob Thornton. I will watch it because you've been going on and on about it.
Been sending you clips.
Yeah, I know.
Why didn't we learn this lesson from Fargo? I mean, take any Midwest show, so good.
It works.
It really works. It's great.
Coming up next on the program, Steve Rasciuto of Mizuho and Phil Camporelli of JP Morgan from New York City. This is Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
60 minutes away from the opening bell with equity futures at session highs. A nice bounce in the last 10 minutes or so. We're high by 0.6%. With 60 minutes until that cash open, let's get you some movers. It's Manus Cranny. Hey, Manus.
Jonathan, good morning. And it is the chips where we're seeing a little bit of a frisky move. Bottom of your screen, you're going to see Intel up 6%. You can take your punt on why it is. But Barclays have a big note out, which permeates across all of the chip sector, but digs into Broadcom. What they say there is they're raising the price target to $260 from here. They're staying overweight. They stay overweight semiconductors generally. They like the CapEx story. And of course, you're going to see this market bifurcate into the have and the have-nots in the AI world, where they struggle, and that's why I'm struggling to understand the move in Intel. They're going to struggle to get more positive on cyclical semis, analog, PC, and handset, yet Intel is flying by nearly 5%. Let's see what the story unfolds there. Apple, I brought this to you earlier, down 4% yesterday, regaining a little bit of footing this morning. This stock is down nearly 9% in the month of January. They had a pretty awful iPhone sales in the fourth quarter, as you know that. But Evercore say it's a tactical outperform. The strength in services and wearables is going to be the key. Yeah, the big wild card is China, but for them, iPhone 17 and the SE Plus is another one that is perhaps better than feared. Rounded off with a little bit of crypto, we know that there's potentially an executive order coming down the pike on a national Bitcoin stockpile. That's a sort of a given in this, but bear in mind Coinbase, post-election frenzy, but the stock closed down 27% into the close of the year. We clawed back 50% of that. And Oppenheimer come out and they say this is a buying opportunity. This is where you've seen perhaps the worst of it past, and it's trading at a bargain. A bargain. I love a bargain. Bargain discount relative to Robinhood. Everything's a bargain until it's a bit more painful in the pocket.
Manus Cranny, thank you, sir. Appreciate it. 60 minutes out from the cash open. Let's turn back to the Federal Reserve. Cleveland President Beth Hammack telling the Wall Street Journal, quote, "We still have an inflation problem and need to continue to finish the job." This is Governor Chris Waller, says cuts could come in the first half of the year if inflation data stays favorable. But Steve Rasciuto of Mizuho expects the Fed to stay on hold through 2025. And Steve joins us now for more. Steve, good morning.
We started on the same day.
Good to see you. What explains the difference right now for you between the likes of Hammack and Waller?
Yeah, there is a real disconnect between the belief as to whether or not global disinflationary pressures will dominate over domestic cyclical inflation pressures. And that's the debate. That's why there's the confusion even amongst the members of the FOMC, because it is a really important question as to whether or not that global deflation, especially with a stronger currency, will overwhelm the inflationary implications of a very tight labor market and an economy running above trend for 5 years, which is the longest period in the post-war that we've ever seen the economy run above trend, and yet we've got this Federal Reserve that thinks it needs to cut interest rates.
Danny brought this up. I do want your opinion on this. Is Governor Waller auditioning to become the next Fed chair?
Quite possibly, but I don't think the audition for Donald Trump is, oh, we've got to worry about inflation or we've got to tighten interest rates. I do think the concept that cutting interest rates automatically leads to lower long-term interest rates is a mistake. We've seen that now for 100 basis points. And yet I don't think that's fully accepted by this administration, incoming administration yet.
Given that they've cut, yields have gone higher, what is the risk that this is a Federal Reserve that has allowed the bond market to get away from them, and allowed the bond market to get away from them at a time where you have the administration that does seem more acutely aware of that and of the pressures and maybe their ability to turn around and pressure the Fed themselves?
Well, I mean, if this Fed were to take the directive saying, I really want you to target 2% inflation, then I think you would have a strong argument that yields should move lower over time. The problem is this Federal Reserve feels 2% was too restrictive. they're probably more comfortable with it being at 3. That's fine. If you're going to say it's at 3 and you're going to defend it at 3, that's fine. But the bond market needs to reflect what that means. The bond market today doesn't. And the reason why it doesn't is most of the people in the business only remember the new normal period, which I've said before on the show. That was the biggest mistake Bill Grove ever made. That was not a normal, that was an anomaly. And trying to think we can go back to an economy running at above trend economic growth with 3% unemployment and 2% inflation is just not valid.
So one of the arguments that I have heard to say, okay, this is disinflation happening, it's just happening more slowly, that the consistent piece of data that we continue to get are things like the quits rates, that workers are not leaving their jobs, and those who do leave, it's harder to find a new job. And therefore, you do see this just ever so slightly slow grind lower in wage growth, and that means soft landing is on track, opens the door to cuts. What do you say to that argument?
Well, again, that was a 2024 situation. And it was a 2024 situation because the perception was we were going to get a big tax increase in 2025. So therefore, companies were sitting there saying, I've been underperforming on earnings. Remember, 2023 earnings were up less than 5%. I have to start control costs. How do I control costs? I slow down the pace of employment. I now got up to 10%, effectively 10% earnings growth. And now I no longer have the prospect of tax increases. Do I now go back to the situation of growing my business because I'm pretty comfortable now that I could get 10 to 15% earnings because we're probably going to have a 6% nominal GDP? And does that then change the dynamics where we're sitting here 3 months from now saying, gee, the quit rate is going up. People are getting jobs pretty quickly. What's going on? And the answer is that's what's going to happen. You've unleashed animal spirits. Even before they've actually executed anything whatsoever, you have a change in mindset. Look at what's happened in terms of M&A activity. The announced deals have picked up significantly. Why? Because we know there's a more friendly administration coming down the pipeline, so people are starting to move things. And even though we say M&A destroys jobs, it may take out some jobs initially, but it tends to create jobs over the longer term.
Okay, so let's talk about some of those policies that we're actually going to see begin to be implemented potentially as soon as Monday. You mentioned deregulation and M&A, very excited, light regulatory charge, fine. What does potentially the immigration policy mean for the labor market at the same time that we might have a tariff policy that, whether it's inflationary long-term or one hit, it could be inflationary?
Let me step back. I'm not so sure it's going to be inflationary at all. Again, this is where I disagree.
Even the washing machines from last time around?
I think what winds up happening is with the dollar getting stronger and with global excess supply, look around the world. The world's a mess. Okay, and we've produced more global excess supply after COVID than we had before it. So I honestly think margins take a hit for suppliers into this country, and I think the currency offsets a good portion of that. Getting back to the immigration concept, I don't think there's any realistic argument to suggest that people want to go out and deport even illegals that are adding productively to the economy. I think there may be a decision to deport people who are coming into the system because they've been arrested and maybe then getting deported, as opposed to going out and trying to get a vacuum cleaner and sucking all these people up.
Speaking of tariffs, we do have Chinese news organizations reporting right now that Trump and Xi are holding a phone call. So it looks like he's getting ahead of potentially what this tit for tat might be. When you look at the tariff policy, do you think that's where it's going to be headed? Less so in Europe, maybe Canada, Mexico, mostly focused on Beijing?
Oh, clearly, he started that particular piece of the equation, and that particular piece of the equation has become consensus conversation, and I think he's going to continue to push on that because it is a big national security-related issue. Again, a lot of what's done here, I think, is positioning. And I think we have to then go back and wait to see what actually gets accomplished. I don't know where they're going to go with this. I don't think a lot of people do. And I am disappointed by the bond market's desire to believe that the incoming Treasury Secretary somehow or another makes every bad possible thing go away, because that's not the position of a U.S. Treasury Secretary. And I'm not so sure just because you've been successful in business, you're going to be a great Treasury Secretary. We've seen several successful business people be horrible Treasury Secretaries. It's a very difficult job. And a lot of what you're doing is coordinating efforts with people on the Hill to get things done for your president. And just because you're really successful at your job doesn't mean you're good at doing that. There are certain people like a Steve Mnuchin who had the skill set to do it. There are other people we can mention in history, but most people, viewers, wouldn't remember who they were. But the reality of the situation is making the assumptions we're making is the mistake. Perceptions are not reality. And this is the point I was getting at with regard to the 10-year note. People are saying 480 is a great level to buy because how long has it been since we've been there? 5% is a fantastic level to buy because we haven't, we touched it once in 2023, and then you're going to go back to 2007. I wasn't even in the business in 2007. Well, I was in the business in 79. And I can tell you, that's a fair level of rates. It's actually a very accommodative level of rates. And people are worried about the mortgage environment in this country. The mortgage environment is not the reason why we aren't getting housing in this country. The problem with really housing is that we don't want to build homes because it's very expensive to do it. We've taken out the speculative aspect of that market through things like Dodd-Frank. But in addition to that, the price of the homes are high. And we have to remember, we do have an aging population, so how much more of this do we need? So housing really doesn't add that much to the economy.
Well, Steve, you also know that the effective mortgage rate in the United States of America is around 4% at the moment. It's nowhere near what the market rate is, and a lot of people are locked in. So we have a supply issue, but for different reasons.
Well, again, why would you leave unless you have to go do it, unless you really need to expand?
Do you not think then reducing interest rates would unlock some of that supply?
No, I don't.
People would feel more mobile again.
No, I don't think so.
Why not?
Because I think a lot of people that are in the position where they've locked in, given how low their rates are effectively, some of them that we know in particular, personally, anecdotal information, is they've opted to rent their home.
I'm trying to get Lisa to sell her home.
Yeah, exactly. I knew you were going to say that.
That's what I'm trying to do.
She's at
trying to do an exchange.
3%?
I think she's at 3%. It was a great trade. Yeah. You won't be the first person to complain about the bond market. You won't be the last. All right, Steve? It's good to see you. Steve Rashuda there of Mizuho. Just want to get you up to speed on that headline that crossed the Bloomberg just moments ago. A report that President Xi and incoming President Donald Trump have held a phone call. No clarity or details on what they actually discussed, which is the important part going into next week.
Hopefully we get a readout. Even though he's not the president yet, he will be the president on Mondays. Hopefully we get a readout what him and Xi Jinping discussed, because obviously we're seeing a lot of different policies regarding China be discussed. Scott Bessent was very bearish on China yesterday in his hearing. Talked about the fact that they think they're in a recession, they think they're in a depression. Talked about the national security concerns when it comes to China, and the fact that maybe they will be using tariffs, either blanket negotiating chip when it comes to Beijing. At the same time, Donald Trump invited Xi Jinping to come to his inauguration. Maybe this phone call was just an RSVP. I'm so sorry I cannot attend, but I'm going to send my vice president instead.
I think it's just a good moment also to take a step back and think about how different it is than 4 years ago. Hours after Biden's inauguration, China had issued sanctions on 28 Trump officials. Then months afterwards, we had finally talks between the two sides that completely fell apart in Alaska. This is a very different starting point, and at least positively for the market, despite some of the hawkish people in Trump's cabinet, talks are happening and people are attending the inauguration.
He understands how to be president. He understands where the levers of government are. It's going to be a different one, a very different one, which is why so many people think they're going to move so much more quickly this time around.
Because he understands where to push, where to pull, and also based off conversations I've had with people in the Trump administration, one thing that they want to do that's very different, geopolitically speaking writ large, not just when it comes to China, they understand the power America has with its military might and its capital markets, and they're willing to brandish it around the world the same way they don't think the Biden administration was.
Equity futures right now positive by 0.7%. Session highs going into the opening bell, about 45 minutes away. We've got equities up and we've got bond yields down. Bond yields down in America by, let's call it 4 basis points now. So this rally's picking up. We're down 4 on a 10-year. We're down 5 on 30s. Phil Camprodi of JP Morgan Asset Management keeping a close eye on Fed policy, writing, we believe the Fed will be on the sidelines for the first half of the year. Less easing from the Fed is much different than tightening, particularly if the easing is not needed by the economy or the stock market. Furthermore, this economy is not interest rate sensitive. Phil joins us now for more. Phil, good morning.
Good morning.
Tons to unpack there. Last time we caught up, you talked about a soft landing, gradual rate cuts, and a broadening out of equity returns. Does this setup challenge that?
Yeah, so we have new information, John. I think, but what's not new is that the 10-year Treasury rate continues to push around the equity market. I mean, the 10-year Treasury rate's boss at this point. You saw that last week with the payroll report. Yields spiked, and the equity market had its worst day since the Fed's hawkish cut in December. And then Wednesday, Danny, you said it, we got like this little bit better than expected inflation, and we had the best day since the day after the election? Are you kidding, right? So we're still very interest rate sensitive when it comes to the equity market. But the true north here, John, and we've kind of come full circle, is inflation. I mean, last year we came in and we probably sat at this table 12 months ago and said, is inflation going to cooperate enough for the Federal Reserve to cut policy? We went to the summer and it was, now it's time for policy to adjust. Fed cut rates by 100 basis points last year. And now we come into this year. Is inflation going to cooperate enough for the Fed to cut policy? But John, our true north still is this very low probability of recession that we have over the next 12 months, which is akin to the story around the soft landing, the broadening out rally. And I just can't say enough good things about the U.S. consumer. I can't. I don't even know where to start. Whether it's, all-time high in household net worth, 20 straight months of positive real wages, 20 straight months. And then the coup de grace, you mentioned it in the last session. People's first-time homes just became their forever homes because of their forever mortgage rate.
They are locked in.
And they're locked in. And I think that that is the biggest reason why we didn't go into recession in years like 2022 and 23. And that's a very slow-moving signal, John.
Well, Phil, lucky for you, basically everyone who thought there was going to be a recession last year just got slapped in the face and has completely removed all of those calls. But does that mean every time you see a sell-off that's prompted by something like yields, you just want to buy that dip? Because as you say, it's about consumers still spending. It's about a strong economy that has been able to withstand high yields.
So, Danny, good question. And people have come on the show talked about, but why are yields moving higher? I think last week with that payroll report, there's no such thing as kind of good news is bad news when it comes to the labor market. If you're producing jobs, that's a really good sign. Yields went up, and I think that was a reason, why the equity market was supported this week. But if they're going up because this kind of unhinged acceleration, whether it be shelter, whether it be insurance, or any service sector, lodging away from home, if that stuff, food away from home, if that stuff is going up, Danny, that's a warning signal for us. That's probably the biggest risk that we have. It's this cost-benefit analysis that policymakers need to do here. Does the benefit of lower rates outweigh the cost of potentially accelerating inflation? And that would be a pause or a warning signal for us. We don't see it. And, nominal growth is made up of two things. It's made up of real GDP growth and inflation. If the inflation part is going up and real growth is coming down, that's bad nominal growth. But right now we believe about a 2.5% real GDP, 2.5-ish% inflation, 5% nominal growth. If you Google nominal growth and S&P 500 earnings, you're going to get a really nice picture. And that's what we're counting on.
Recent Michigan survey, though, was talking about consumers, their expectations are going to be much higher for inflation. Are you concerned about a self-fulfilling prophecy?
Yeah, like I mentioned, the inflation story is not over. There is no we're declaring victory.
But you say consumers are doing well, so at what point do you think they really start to push back?
Yeah, I think that goes back to the wage story, Anne-Marie. So if you have, wages right now, average hourly earnings 3.9%, that's right on top of the 50-year average. Back in 2022, when the Fed was raising rates, it was up at around 7%. So I think the consumer, if we go to a labor market that unemployment rate going below 4%, average hourly earnings picking up, that would be a warning signal. And, inflation is okay. Again, if you get the real GDP growth on the other side, it would be the stagflationary part that we would worry about, and we're not seeing that right now.
Headline crossing a terminal moments ago. I'm sure you heard us talking about it, that she and Trump had held a phone call, according to reports. What are you expecting on trade in the next few weeks? What's the base case for you and the team?
Yeah, good question. And there's two parts of this, John. The first part, and we've talked a lot about it, the deregulation side. That's the positive. The wild card is going to be the headlines around tariffs. Annualized performance of the S&P 500 in Trump 1.0 was 16% annualized, with all of the noise and headlines.
Stock did well.
Around tariffs.
Economy did well.
Around
Biden
tariffs.
kept the tariffs. Stocks kept going up. Does it make a difference this time around?
We don't think it does. We wouldn't be overweight 9% in stocks if we, in a 60-40 portfolio, if we believe that the tariff issue was going to hurt kind of growth and earnings and things like that. I think that the bigger positive is the pro-business environment from President Trump.
What is it about this? And I'm intrigued. I'd love your opinion on this. So I get it. They're pro-growth.
Yeah.
But for me, it might be like a football game.
Yeah.
With and without cheerleaders.
Soccer or American football?
We can go with your version because we don't have cheerleaders in soccer. the game's the same. 3% GDP under Biden. They may not have been pro-growth. They didn't talk well about business, and they were very much against M&A. How different is it going to be? The actual economy, not the cheerleading, the actual economy.
The actual GDP number is not going to be very different, okay? But if you look at the small business survey in the last 2 months, John, we saw the biggest 2-month jump in the 39-year history of that survey across the board. And, you know, when we talk about deregulation, it's not just that you're going to get less kind of cost of rules that were under Trump 1.0. Do you realize the Biden administration in the 4 years had four times the cost of regulation than President Obama, not President Trump? So this is something that we think is going to, and we're seeing it in the surveys, something that we think is going to be really positive, adding to that kind of broadening out rally. Mid-cap, we don't have as much mid-cap as we did in December when I was here last time because, you know, again, the new information on inflation risk, but we still do like a combination of large cap and mid-cap in the portfolio. And in fixed income, this is the highest starting yield on the 10-year note since 2007. Okay, coming into a year. Again, we got to 5% before, but starting the year. So we need a backup of about 75 basis points to break even with kind of the coupon. We don't love core bonds here. We like high yield a lot more. That's adding durability to the portfolio. But as an asset allocator, we do have to think about kind of the cost benefit with core bonds here.
Phil, it's good to see you. As always, buddy. Great to catch up. Phil Camporelli there of JP Morgan. Equity futures up here by 0.7%. Let's give an update on stories elsewhere this morning. Here is your Bloomberg brief. Bloomberg reporting that President-elect Donald Trump is planning an executive order to make crypto a national priority. The team also reportedly considering the creation of a national Bitcoin stockpile. We'll see. Elsewhere, the US government targeting Novo Nordisk's blockbuster weight loss drugs, Ozempic and Wegovy. The drugs will be subject to price negotiations in an effort to reduce Medicare costs. The legislation hopes to save the government more than $200 billion over a decade. And finally, SpaceX Starship rocket exploding just minutes into its 7th test flight. The rocket losing its top section, but its lower portion was brought back down to Earth successfully. SpaceX CEO Elon Musk pointing to a possible leak and saying next month's launch is still on track. That right there is your Bloomberg brief. Up next, we'll set you up for the week ahead with one thing in mind. Day 1 of Trump, version 2.
Behind the bright lights and adrenaline of pro sports is an equally exciting world of negotiations and deal making.
That's what we cover each week on our podcast, The Deal.
I love the fact that you have, we say the cojones, I can't say that in Bloomberg.
Maybe moxie.
Yeah, moxie. I'm Alex Rodriguez, former baseball player turned business executive.
And I'm Jason Kelly, a journalist at Bloomberg. Over the next couple months, we'll hear from all-stars like Billie Jean King.
Well, what should I learn? What should I do? I said, learn the business.
Jay Williams.
You're the asset, but how do you become the principal?
Paul Rabel.
We're going to be the league of digital, and that's why you're going to invest.
Adina Friedman.
I definitely am competitive.
David Rubenstein.
People don't come up to me on the street and say, let's talk about this private equity deal you did recently. No, nobody does that. They say, let's talk about the team.
And so many more.
You need a clap?
No, I never. Ready? Go.
Good morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. Bloomberg brings you breaking news 24 hours a day, powered by 2,900 journalists and analysts in more than 150 offices across the globe. Bloomberg Television. Context changes everything. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Equities up here on the S&P 500 going into the opening bow. We're positive by 0.6%. Next week, shaping up as follows. On Monday, Trump's inauguration and the World Economic Forum beginning on Tuesday. Earnings from Netflix and United Airlines on Thursday. Another round of jobless claims. And on Friday, a BOJ rate decision plus some data in America, including US PMIs and new mixed sentiment. As we count down to Inauguration Day, let's catch up with Bloomberg's Tyler Kendall for the latest in Washington, D.C. Tyler Kendall, a call between President-elect Donald Trump and Xi Jinping. What's the news?
Yeah, good morning, John. Well, news of this call coming, of course, as China's Foreign Ministry of Affairs confirmed yesterday that they will be sending the country's vice president to Trump's inauguration. Also coming as we get more news about who else will be there. We know Bloomberg News is reporting that a whole host of CEOs, including Elon Musk, Mark Zuckerberg, Tim Cook, and also Jeff Bezos will be there. And then new reporting that TikTok CEO Shou Chew could also be in attendance. Of course, as you've been covering on the program all morning, Inauguration Day coming just one day after that expected ban will go into place on TikTok unless the Supreme Court intervenes or they announce some sort of deal to divest. Now, I had the chance to actually catch up with Democratic Senator Mark Warner on Capitol Hill yesterday. He's the ranking member on Senate Intelligence, and he was the chair when the TikTok ban first passed. And he said that he was confused by this invitation and that he doesn't understand how it squares with the incoming administration's get tough on China rhetoric. Of course, John, President-elect Trump would likely he wouldn't likely not agree with that assessment, considering he says he's trying to broker a deal with all sides to get this negotiation over the finish line.
Tyler, thank you. Looking forward to your coverage into the weekend and on Monday morning. Bloomberg's Tyler Kendall. Tune into special coverage on Monday, 11 a.m. Eastern Time. Helping to lead that coverage, Bloomberg's Anne-Marie. You'll be breaking this one down. We'll be over in Switzerland, breaking down the reaction to everything that happens in Washington next week.
Yeah, so I'll be at the Capitol when President-elect Donald Trump will be sworn in. 45 becomes 47. And then what's going to happen is everyone in Europe at Davos is going to be running around trying to understand what this all means.
It's a Trump takeover, and he's not even there. This is the lineup for next week. Some highlights for you. We'll catch up with JP Morgan's Dan Pinto, NICE President, Lynn Martin, the Bank of America CEO, Brian Moynihan, and Morgan Stanley's Ted Pick, and a whole lot more. Looking forward to breaking it all down with you. From New York City, enjoy your weekend. This was Bloomberg Surveillance.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
What prompted you to want to get out of just doing surgery to be an administrator and a hospital leader?
Watching others who did it well. I had a dean who recruited me from Birmingham, Alabama to Minneapolis, Minnesota, which is a big jump to convince me to move my family. I realized over time that my training as a surgeon brought a set of credible things to the table. One, if surgeons have a measure of emotional intelligence, not much of our training reinforces that. It reinforces skill, not necessarily emotional intelligence. But if a surgeon has some self-awareness and emotional intelligence, what they bring to the table of leadership are three fundamental things. Number one, they do everything in teams. Their operations, their patients they see is all team focused. Number two, They value process, but they hold themselves very much accountable to execution. They understand that it's good to explore a patient, but what really matters is that you take the tumor out. And then number three, they make difficult decisions on incomplete information. Those things I realized that I could bring to the table as a leader if I had a sort of a passion for working with people and had some sense of self-awareness.
In case you missed it, on Bloomberg, the China show.
What's been the sentiment? What's been the reaction to this U.S. election outcome on the ground?
They were pretty much ready for Donald Trump. There was a high expectation that he could return to the White House.
We have dealt with him before, and after quite a few years, China simply is better prepared, and China, psychologically speaking, is much more prepared than in dealing with him again.
Probably are fully prepared for Trump to impose higher tariffs on China.
What's the tone as they were talking to really a global investment?
Right. The openness of China, including the capital markets, Hong Kong being an international financial center.
Don't miss the China Show live every weekday.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
It is the last trading day of the Biden administration. 30 minutes until the start of the cash trade. I'm Matt Miller.
And I'm Sonali Basak.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
Coming up, the clock is ticking for TikTok. The Supreme Court is set to rule on the app's shutdown as the incoming President Trump pledges an extension.
And mining M&A, Rio Tinto and Glencore have discussed combining their businesses, what could result in the industry's largest ever deal.
And the U.S. plans to negotiate lower prices for Ozempic and Wegovy, which, of course, are Novo Nordisk's blockbuster GLP-1 drugs. Novo shares down sharply pre-market. All of that and more coming up. Let's take a look at where the broader markets are trading right now. We have a rally on our hands on this Friday, at least in the pre-market session. You can see the S&P 500, the NASDAQ 100, both up mightily right now. Remember, we saw some enthusiasm at the open yesterday. That faded by the close, but for at least right now, quite a rally to end the week. Same story, too. If you take a look at the bond market, yields down a little bit at the long end of the curve. The 10-year Treasury yield currently down about 3 basis points. We are below 460, Matt Miller.
Yesterday, Scott Bessent said discretionary spending is up 40% in the past 4 years. We have new functionality on the Bloomberg terminal. This is ECAN Go, E-C-A-N Go, and you can see all of government spending broken down into the most minute detail. In green here, you see debt servicing costs now at more than $100 billion a month. This is something that the next government is going to have to tackle.
It's such a circular issue, isn't it? If you can get that green line down, then you have debt servicing costs lower, but also maybe you have that 10-year, if it stays below 4.6%, that could start to happen a little bit anyways. We'll keep an eye on all of that. Novo Nordisk, we're watching, as Katie said, down bigly, a 4.4% pre-market, sliding after news that Medicare price negotiations will target Ozempic and Wegovy. We're also looking at Intel shares jumping after a report from the website Semi-Accurate. The website said that the company may be an acquisition target. We've already been watching Intel. It's up almost 8% now pre-market. We have been talking about potential asset sales. Let's see where the story goes. Bumble also up 6.2%. They say that founder and executive chair Whitney Wolfe Herd will become CEO. She's coming back to that top spot effective mid-March of 2025. A lot of news changing at the top ranks of companies these days, Matt.
All right, we also have breaking news out on the global growth outlook from the IMF. They are raising their 2025 forecast to growth of 3.3%. And the reason for that is stronger growth right here in the USA. So it does look like U.S. exceptionalism continues to be a theme in 2025. Katie, what do you think?
Absolutely. I mean, the biggest upgrade among the major economies, U.S. GDP rose 0.5 percentage points to 2.7%. This is what we've been seeing in the stock market, right? You think about the resilience of the U.S. economy, the strength of American companies, particularly American tech companies, and then you take a look at the rest of the world. It doesn't look too good. At least that's what we hear from some of the bulls that we speak to on this program.
Right, and it should give the Wall Street crowd a reason to be a little more bullish as well. The estimates coming into this year were all over the place. You saw people looking at below 2.5%. Soft landing scenarios were still being baked in. This rise in the IMF projection should at least give a little bit more confidence for that U.S. growth story.
Let's bring in Alex Chaloff right now, Bernstein Private Wealth Chief Investment Officer, here with us at the desk. Alex, thanks so much for joining us. Good morning. Let's kick it off with this, increased growth estimate, and it's really on the back of a stronger U.S. as, the next president of the United States is sworn in on Monday. What do you expect for 2025?
Our view is that we'll have good but not great growth, and that's actually perfect. It's a real thread-the-needle situation. We'll have about 1.5% growth, 1.6%. To be precise, is our view for U.S. growth this year.
So that's far less than the IMF. The IMF says 2.7%.
The economists are terrific on one hand and on the other hand and changing their outlook, and I would bet dollars to donuts we're going to have a change in view over the year. By the way, a 2%, a 1.6%, a 2.2%, it's all directionally the same. Modest growth that doesn't kick off another bout of inflation and good results for investors.
It sounds like you might stand a little bit outside of the crowd that I just described, though. When it comes to the global picture, we hear a lot of people that say, don't touch Europe. It's not even worth looking at when you consider what's going on in the U.S. It sounds like maybe you don't buy that argument.
You have to be global, especially now, and especially if you've lived through this U.S. growth cycle where earnings have been terrific, where multiple expansion has been terrific, where the stock price performance of a lot of these companies has been great. Now to pull off a non-U.S. position and say, okay, I give up, capitulate, that this is not the right time. There are some opportunities that exist outside the U.S. We are still U.S. bulls. We still have a majority of assets in the U.S. for our clients. And in fact, we've raised our U.S. weighting this year relative to the past. We are at the highest U.S. weight we've ever had in our model construction, but we still like non-U.S. markets.
Dollars to donuts. Have not heard that one. I'm working on my idioms, as Matt knows. Why do you believe that things might not be as rosy?
I think that we get excited about the U.S. consumer. We get excited about the labor market, but it's a little bit of a sneaky labor market right now. Job growth is good, but behind the scenes, there are a lot more people looking for new roles. And you're not seeing that kind of turnover activity. You're seeing people coming back into the workforce, which is great, but there aren't those kind of lateral moves for better career advancement. I'm going to call it a sneaky job market right now.
What did you think about Besant's testimony yesterday? I thought it was really interesting that he said, in terms of the TCJA, extension of the tax cuts, this is the single most important economic issue of the day. It's pass, fail. And pass, by the way, means an extension, right? Because otherwise it would be $4 trillion in tax increases.
Yeah, it's reasonable to expect tax cut extension. I think that's a base case that we're modeling. I think everyone's modeling. I think what he's really saying behind the scenes is, you better give this to us, because if you don't, a lot of people are going to be upset. And I think that's going to be the case. Our view is that there will be extension.
Well, let's wrap this into a conversation about what the Fed is going to do. That seems to be one of the big wild cards in the market. You take a look at the Fed speak over the last 24 hours or so. You had Christopher Waller sounding a bit dovish. You had newcomer Beth Hammack saying that we still have an inflation problem. Not a voting member, but interesting to read the different tea leaves there. What do you think the Fed is going to do? Because you take a look at bond traders only pricing in about one rate cut this year.
That's right. That's right. I think this is where the disagreement is greatest, which I love, because that's what makes a market.
Our view is too.
Good. All right. We're all on the same page. I think they're not going to do anything until June. So we can all just relax, watch the 10-year bounce between 4.5, and I'm thrilled to see it bounce back down closer to that than when it was up at 4.7. I think there was some I don't want to say panic, but close to, because the 4.7 is 5, and then we're back in where we were in 22. But nothing until June, and then our view today is that there's 3 cuts, and I think that's not a high conviction view, but I think that there'll be at least 2. And frankly, the inflation is coming down. The levels of inflation are coming down, both the sticky, both the Atlanta sticky, Atlanta flexible. You're seeing real reduction there. And I think the Fed will have the support to cut at least twice, and maybe we'll get that third cut.
You know, Alex, I think a lot of what you're seeing in terms of this discrepancy in futures pricing for bonds is that uncertainty around the neutral rate. Going back to the hammock comments at the end of last year as well, the belief that we're closer to neutral than we think. What do you think?
Well, I think that we're not going back to where we were. There's no more ZIRP. That's over. We're not going to go back up. Our view is that there won't be a re-hiking cycle. I think you'll probably settle in over a longer period of time. Chair Powell still has a couple of years left, and I think they'll be very deliberate during the remainder of his term to move slowly rather than quickly, because they don't want to have a policy mistake. They don't want to have to go back the other way. So I would say elongate the expectation of timing, and we're still going to get there.
All right, Alex, got to leave it there. Always great to kick off the show with you. That is Alex Chaloff from Bernstein. Let's turn to some breaking news that we got this morning, and that is that the U.S. will negotiate the price it pays for Novo Nordisk drugs, including Ozempic and Wegovy. They are the latest drugs that are targeted under legislation that expected to save the government more than $200 billion over a decade if all works out. Bloomberg Intelligence senior pharma analyst Sam Fazeli joins us now. And Sam, you think about Novo's treatments. In the U.S., they have list prices about $1,000 per month. And the last round of IRA negotiations gave Medicare an average of 22% in terms of price cuts. If this goes through, if we see a similar magnitude of price cut, what would this mean for Novo Nordisk's bottom line?
Yeah, thanks for having me on today. This is obviously an interesting day today because this is a date that wasn't supposed to be the release date for the data, although we'd expected the Biden administration to pull this forward from the 1st of February expectation. What does it mean for Novo Nordisk? I mean, look, at the end of the day, they're not going to change their list price necessarily. They're going to end up having to write a check to the federal government for whatever that difference is in terms of the negotiated price. Not sure this will actually help the patients necessarily, depending on the way the plans are operated. So at the end of the day, it does impact Novo Nordisk. It all depends also on the size of their business from Medicare. And I don't think currently that's a significant number because we're still waiting for full coverage for obesity, etc. So in the meantime, it just adds to a flow of bad news for Novo, starting just before Christmas for the latest drug, CagriSema.
Yeah, it was wild to see Novo shares actually fall in 2024 after quite the run that they had in the years prior. I want to talk about what this means for Eli Lilly, because you don't see Eli Lilly's drugs on this initial list. There is some speculation about 2029 maybe. But even if we see price changes for Novo's drugs, what could that mean for Eli Lilly?
Yeah, it actually could help Eli Lilly, which is, a bit. It's not what necessarily was the expected outcome in these things, right? Because if the plan operators are not getting the rebates that they were getting before, they're more likely to want to emphasize or favor products where they get the rebate still. And that would mean that rather than Novo writing the check to the federal government, if you end up pushing for the use of Zepbound more, or Mounjaro more than the Novo drugs, that the plan operators get the benefit, and that's an incentive to them. So this is one of the issues with the way that the whole IRA is structured with this price negotiation. And of course, as you know, and Bloomberg has reported this, a lot of the pharma companies have got together asking the new administration to just stop, even though this list has been published, and review what the actual outcome of these negotiations are.
And what is your expectation, Sam, for the Trump administration? Because on the one hand, he's expected to be pro-business. It would make sense that he throws out sort of the Biden attempts to negotiate prices. On the other hand, he's a populist president, and people are pretty angry when they hear that these drug makers are charging exponentially more to U.S. patients than they are to, German, British, or Danish patients. Is Trump likely to try and stop these drug companies from exploiting U.S. patients?
Yeah, so I don't think that the new administration would make a significant, or needs to make a significant change to the IRA. It's just that some of these bizarre incentives that are created by its system need to be addressed. If you're now not going to actually change have any impact on the actual patient's bottom line, although it depends on the type of drug and how it's paid for, then what's achieved? It's the money is going to the federal government. Are they going to pass it on to the patients? In how is that going to happen? So I think what I hope will happen is that they look at this and say, okay, there are good parts here, and that's great. Sort of capping out of pocket costs, perfect. Negotiating some price, maybe, but let's make sure that the benefit goes to the patient as opposed to anywhere else. Are we incentivizing innovation? Certainly not, with the element where they say drugs that are small molecule drugs that are the most valuable when it comes to generics get a shorter cover. Those are the things that need to be fixed. And I think Trump administration can have its cake and eat it. They can keep and actually make it better for the patients.
Sam, we have to leave it there. We thank you so very much for your time and all of your analysis. That is Sam Fazeli of Bloomberg Intelligence. I also want to bring you now some breaking news. Goldman Sachs announcing it is raising CEO David Solomon's pay from $31 million to $39 million. Interestingly, also, and very notable, the compensation committee approved with the board just yesterday, incentive packages also for CEO David Solomon and John Waldron with a value of $80 million with a 5-year vesting period. These are getting more common on Wall Street, these tens of millions of dollar packages for these executives. In the case of Goldman, also notable, they are instituting a carried interest incentive program that are tied to certain funds at Goldman Sachs Asset Management. These are alternative funds launched last year across multiple strategies. We were talking about Goldman's expansion into private assets. This is tying the executives and their own performance pay to those funds. We will talk more about this later in the show, but of course it's that time of year, it's payday. Now yeah, go ahead.
Well, I was just going to point out, I mean, I always look at the performance of the stock when I hear about the CEO's pay getting increased, right? And if the company is doing well in terms of stockholder appreciation, maybe they deserve it. If you look at Goldman Sachs versus every single other bank on the street, it has outperformed over the past 5 years with total return of 180%.
And they have the second best year ever. So they want to make sure their talent stays on board for the next 5 years as well, particularly as they're going through some significant changes. Again, we'll talk more about that later in the show. But before that, we're going to talk about TikTok. The ban could reshape the social media landscape. We're going to discuss what it means for stocks like Meta and Snap. This is Bloomberg.
Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
I think one of the dirty little secrets of credit is that the businesses generally don't pay you back, right? The markets pay you back, M&A pays you back. So what is the most important thing is to always make sure that the borrower is worth more than the loan. And as long as the borrower is worth more than the loan, then it might be a rocky ride, but you're going to get your money back. And this world where there's these disruptive companies that have, let's call it 100, 200, 300 million of ARR, are looking to not raise equity capital because of the fact that they raised it in 2021 or 2022, and no one really wants a down round. But there's a lot of capacity in the capital structure to have, let's call it a structured solution. We think that there's a lot of opportunity with those businesses.
To the minute economic news whenever and wherever it happens. I'm Jennifer Zabasanja in Luanda, Angola, and this is Bloomberg.
There is this real momentum from Wall Street.
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
TikTok is now coming up against a nationwide ban on Sunday, but Donald Trump and his team are working to save the popular app used by 170 million Americans. Bloomberg Intelligence senior analyst Mandeep Singh joins us now. There was a perception that if TikTok were to be banned in the United States, that a lot of that activity would go to the other popular social networking sites like Meta, for example. But you're seeing that not necessarily the case, aren't you?
Yeah, you're right. I think the secret sauce remains the algorithm and the user and the followers that they have on TikTok, which is why the copycats that have emerged, the Red Note and the Lemonade apps, out of nowhere, they seem to be gaining a lot of users. In fact, people have started learning Mandarin through Duolingo because some of these apps have a lot of Chinese content. So clearly the users who are on TikTok want their graph to be intact, and if any app offers an alternative, they're ready to use that app as opposed to a Reels or a Snapchat.
Yeah. I don't know, because I'm so far away from the demographic of a TikTok user.
I can tell you about it.
Isn't it ironic that the U.S. Congress bans TikTok for fear of Chinese spying, misinformation, malware, and then the TikTok users, this whole Gen Z group, just migrates from one Chinese social media network to another Chinese social media network, also owned by the parent of TikTok.
You could look at that situation and say, oh my gosh, is being Chinese owned the appeal? Because that's exactly what has happened. The memes have been amazing, Mandeep, just to put it simply there. But why isn't Reels having a heyday right now? Basically, if you go on Reels, you see content from TikTok that was posted 2 weeks ago. You think that that would be the natural opening for Reels to really take some market share.
I mean, think about, the origins of social media with the Facebook Blue app. People have their users, their family of friends. There is a graph associated with all these social media networks. It's the same with TikTok. There is a user graph of followers. People know what sort of people consume the content. And even though Reels is owned by Meta and, they have all the knowledge in terms of how social media works, they don't have that secret sauce that TikTok has, which is why TikTok is so resisting in terms of selling the U.S. asset. I mean, that's the secret sauce, and they don't want to give it away.
Is there really a possibility that Elon Musk could end up owning TikTok and combining it with X? Is there no antitrust concern there?
I mean, look, given the closeness of Musk to the incoming President Trump, clearly there is a case to be made. If he wants to expand his social media empire beyond X, then
and also the closeness of Elon Musk to the Chinese Communist Party, right?
Yeah, I think they see him as somebody who could be a viable, purchaser of the app, but I still think they will resist, selling the app and trying to figure out a way for the app to work the way they, talked about Project Texas in terms of bringing all the data over and having it audited. So to me, those are the options that the Chinese government is focused on right now for ByteDance.
Really quickly here, do you remember Vine?
Yeah.
I remember Vine. I loved Vine. Vine.
You remember Vine? You must have been 5.
I remember Vine. I wasn't 5. I was in college.
But it didn't have 170 million users. Yeah. That was the difference. Yes.
Yeah, that's true.
It didn't make sense at the time, right?
Vine.
But also there was, I think, a 6-second limit. Was that right?
That's true.
So, and TikToks are far longer.
I watched about 3 hours worth of 6-second videos.
At this point yesterday, the ability of the Chinese social media apps to draw in e-commerce and payments is another big draw that the American giants just not have figured out as well.
Yeah, I think Will Shaker actually pointed out that there was a $28 billion economy built around
I bought my husband's Christmas present on TikTok Shop. It's actually a pretty seamless experience. Mandeep, we have to go. It's great to see you. That is Mandeep Singh of Bloomberg Intelligence. And tune into a full special on the future of TikTok at 11 a.m. Eastern on Bloomberg Technology. But stay here, too. We'll be live at 10 a.m. when we might get a decision. This is Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech. From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onim, only on Bloomberg.
Welcome back to Open Interest. You take a look at futures right now, flying before the bell. The S&P 500 up by about 0.8%. Train your eyes on what's going on with the NASDAQ 100 right now, up 1.7% before the bell rings. Maybe a lot of that comes down to Intel. Of course, we are on Intel Acquisition Watch. Semi-accurate, that is really the name of the organization that published that Intel is the target of M&A. We knew that, but we got a reminder this morning, and you're seeing Intel react, and you're seeing big tech in general have a great day. The Russell 2000, the small caps also getting in on the action as well, up about 1%. Now coming up, less than 4 minutes to go until the opening bell, we'll discuss the market moves with RBC's Amy Lou Silverman. That conversation coming up next. This is Bloomberg.
recent years, you created an institute, the Jane Goodall Institute, and what is that designed to do?
Well, that was started in 1977 when by then I had a little research station and 4 of my students were kidnapped and everything shut down. And so some friends of mine said, well, let's start an institute so that this research can carry on. Bless them. So that was 1977, and it was set up to study, conserve chimpanzees and other animals and educate. And it's developed since then. So it's, you know, we've got 27 Jane Goodall Institutes around the world. And then I realized at some point that the African people living in and around chimpanzee habitats right across Africa were struggling to survive. There was crippling poverty, lack of health and education, moving deeper into the forest, being exposed to diseases like Ebola and HIV from the chimpanzees and vice versa. It hit me. If we don't help these people to find ways of making a living without destroying their environment, conservation won't work.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern. Only on Bloomberg. Context changes everything.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at the Forbidden City in Beijing, and this is Bloomberg.
Moments away from the start of trading on what will be the final day of the first full week of 2025. We hadn't had a 5-day trading week yet. S&P futures up 0.9%. This could be the big one, folks. It could be a gain of more than 2% this week, as Shanali was telling me earlier. It could be the best week that we've seen on the stock market since election week back in November. NASDAQ futures ripping face right now, up 1.9%, and the small caps are not doing badly either. On the New York Stock Exchange, you see QXO coming out. They got a little kid, which is cute, and they just made a hostile bid for a roofing supply company. It's an all-cash deal, which is more exciting, I think, than a stock deal. And then Restore ringing the bell down on the NASDAQ market site. In terms of the major averages, it's looking good, folks, and Katie Greifeld is standing by with the numbers. Katie, what do we got?
Yeah, so far, about 30 seconds into the trading day, it's a good day for the bulls. You can see the S&P 500 up almost 1%. That's being led in a big way by big tech. You can see the NASDAQ 100 currently higher by about 1.7%. Some big movers there, including Intel. The small caps, too, getting in on the action as well, up about 1% on your Russell 2000. Of course, we see interest rates coming down a little bit this morning. That's providing a little bit of relief to the little guys. Meanwhile, you take a look under the hood, and you can find some red. Novo Nordisk sliding in a big way after news that the U.S. plans to slash prices it pays for Ozempic and Wegovy for Medicare. That, of course, is part of legislation that's expected to save the government more than $200 billion over a decade. We'll have to see how aggressive the Trump administration is in those negotiations, but at least for right now, Novo Nordisk down almost 4%, Shanali.
And Katie, as you remember, on Monday, since Monday, it has been deals driving the move in many stocks, and now it's deal rumors. Intel shares are jumping after a report from the website Semi-Accurate, which said that the company may be an acquisition target. Intel shares now up more than 7% as the market opens. We have been watching a lot of potential event-driven activity around Intel the last couple months.
All right, we're also watching Vistra, one of the best-performing large-cap stocks of 2024. The shares are down after a fire broke out last night at Vistra's Moss Landing power plant, and also, maybe more concerningly, an adjoining lithium-ion battery facility in Central California. You don't want to see a lithium-ion battery on fire, because they're really difficult to put out.
Yeah, no, that sounds super bad, so we'll continue to watch Vistra shares. Can we talk about Intel for a moment here? You think about the fact that, of course, it's called Semi-Accurate. There's not a lot of detail here either that Intel might be an acquisition target. We already knew that. Why is the stock up 6% right now?
The excitement around it, again, I suppose. Remember, we were talking about Qualcomm. It kind of went away. Now, who else would come in? Maybe Trump would let anyone buy it. Goodness knows at this point. If you're talking about Elon Musk buying TikTok, I don't know anymore.
I just love the name. If you're in the business of scoops and you name your media company semi-accurate,
can we say one other
help?
thing? One other thing.
It should be
Broader
called
market.
fully accurate.
Or maybe correct news.
Not completely incorrect.
We heard this from someone, news.
I can barely hold my excitement, and we are so close to 6,000, guys, on the S&P 500.
We also have a nice red-hot, sticky headline on the terminal. Former President-elect Donald Trump has had a phone conversation with Xi Jinping, and he is saying they discussed TikTok. Now, that's the red headline. They also discussed trade and fentanyl. And yet TikTok is the one that we made red.
I would really like to know what order they discussed that in.
I mean, those two other things are so
It's just
much
a
more
matter
important
of
than
what
TikTok.
comes first, right? Because TikTok is around the corner.
Maybe they talked only a little bit about fentanyl and just a bit about trade, but a lot about
All
TikTok.
we can do is wait for more reporting, but
And in
we've
the
got to get
meantime-
back to these markets, of course. About 4 minutes into the session, let's keep the conversation going now with RBC Head of Derivatives Strategy, Amy Wool-Silverman, joining us at the desk. Amy, thank you for bearing with us.
No worries.
Let's talk about ducks, because when you see a duck on a pond, you don't really see much up top. It looks serene. You take a look under the water, the duck is paddling furiously to move itself along. You talk about how we're in a paddling duck market right now. Explain.
Well, we are, and certainly sometimes it doesn't feel like it, but look, it's just this idea that the dispersion in the market is really high. You don't necessarily see it in index level volatility, but underneath the surface, we are going to continue to see in 2025 these violent sector rotations. You got a preview of that when the cabinet picks came out for Trump. I only think that will continue as we start to get news, dribs and drabs across the board on cabinet picks, on tariffs, on geopolitics. And I think sometimes your headline VIX is just not capturing everything that everyone is feeling underneath.
We are just over 15 points, 16 points away from that 6,000 level again on the S&P 500, and I can't believe it's taken us weeks to get here. Again, after the exuberance we've seen, we were talking to an investor yesterday, Janice Henderson, who made the point that at these heights, there's more downside risk. Do you believe that?
Yeah, it's interesting. So sort of post-COVID, the options relationships that we've seen really broke down. And one thing we saw that was super weird was volatility would rise as the market rose. And the reason for that was because people really felt this FOMO. They had to jump into the pool. They couldn't miss out on these benchmark rises. And so call options would get bid as volatility rises. This is different, right? Because a lot more people are long. And so physically, I think we're going to see this year of volatility normalization, not for any special reason, just because as we continue to move up, more people have already participated. So I actually think that downside's going to move.
When you talk about, the duck paddling underwater and the rotations, I think of the RRG function on the Bloomberg terminal.
I love that function.
Okay, so it's awesome, right?
Yes.
If you type in SPX index or any index and put RRG, you're going to see a graph of the rotations. I have it set to weekly, and you can see it's like a matrix, right? So the rising stars are over there in the top right corner. You've got consumer discretionary, you've got telecom services, you've got information technology. What do you think about the breakdown of the industry groups? Which is the most interesting for you?
So I'll tell you two things. The first is, just from a dispersion high-level point of view, it's really a good time to be a stock picker, and it really matters that you get those sector picks right, because in these high dispersion environments, you're talking performance is really about where you put the money. It's not these like highly correlated environments where you can just be long. That's first. And then second, when we look down at the sector level For options, like where do you see the most bullish sentiment? It's still in those like tried and true Mag 7 names. You know, you actually haven't seen it shift over to the trades that people would necessarily characterize as breadth widening. You haven't seen option sentiment move there yet. And I don't know if it will, and we just need to catch up, or if that's telling you something about how this year is going to play out.
Well, I'm glad that you can both read RRG, because that looks like a bad trip to me. I feel like you need to be in a specific state of mind to read that
It's
one.
like a business matrix. You know, you've got your cash cows, you've got your shooting stars.
I need time to think about it.
Dogs.
But let's talk about earnings season up ahead. About 40 companies have reported in the S&P 500 right now. In the world that you live in, the options market, the derivatives market, what are you seeing in terms of hedging, of people placing bets when it comes to the upcoming earnings season?
Yeah, so first, I think this will be an important earnings season. And the reason I say that is when you just look at the pricing of magnitude of moves, it's a lot higher this quarter than it has been for, say, the average of the past 8 quarters. So meaning people just expect more single-day earnings movement than they have before. The second thing I'd say is, you know, one trade idea that we've been talking about is just owning NASDAQ downside protection, because especially as you get later into earnings, you get that big Mag 7 reporting. You know, these tend to move the market from just a simple breadth perspective, and we haven't seen that exuberance tick up like we have in the past. It's just been very neutral, which is interesting to me, because in the past we've seen that exuberant spiral, that volatility up, spot up on these earnings events.
You know, speaking of earnings as well, when we've seen some outlooks, let's say from retailers this week, something that's been really sticking with me is how choppy it's been. And it's therefore interesting to me to see that RRG screen point to consumer discretionary as one of the leading sectors here. How fragile is that sector? Especially, yes, I get it, retail sales came in higher but lower than expected. So there does seem to be a little bit of fragility there.
It's such an interesting question. We were actually just talking about Richemont earnings, you know, and those were a blowout. I'm a little guilty of helping their top line, but, you know.
Congratulations.
One thing I'll say is a big topic that keeps coming up with our clients is we've had this K-shaped recovery. Our economist talks about this all the time, where the luxury consumer, when you look at the hard versus the soft data, is really the one pulling through. But will that happen in 2025? Because if they don't, that's not great for your Richemonts of the world. That's not great for your, you know, XRTs, XLYs when you look at that breakdown in constituency. And I think that's a big question right now. The option sentiment does not suggest it's bearish yet. If that starts to pick up, I would say that means maybe there's some concern about that luxury consumer.
Amy Wu, great to have you with us as always. Please come back soon. RBC's Amy Wu Silverman talking to us about the markets. Did you see the Walmart story yesterday?
About the used luxury handbags?
Yeah, it's not just the working bag now. They're doing kind of a real thing.
I am so impressed that you know that.
I think
It was on the Bloomberg top news function, so I'm sure that's how he found it.
But we've had a hard time making him pay attention to Workin' and Birkins before.
That's not true. I'm a huge Birkin bag fan. I'm a huge bag fan, just in general.
Do you own a Birkin? Have you?
No, but I would buy one.
An
I
aspirational buyer?
The craftsmanship, you know,
I'm going to send this
the
segment
leathers
to your
that
wife.
are used.
I hope you know that, so be careful what you say.
All right,
I have
anyway.
the Richemont website up, by the way, now.
Yeah, I believe it. I believe it. But they don't have the Kelly Bit jewelry that you like.
I do. I like to buy local.
All right, we are going to bring you a Bloomberg scoop when we come back about what could be one of the biggest deals of all time, certainly the biggest in the mining industry, if it actually happens. I think it's a pretty big if, but it's still interesting to think about Rio Tinto and Glencore getting together. We'll do that next. This is Bloomberg.
a number of people, I think, from Homeland Security and or the CIA or NSA have gone to Capitol Hill and said that TikTok is a danger to our national security. But the public hasn't been given that much detailed information about what the threat is. How much of a threat to our national security is TikTok?
The People's Republic of China acts adversely to the interests of the United States in different ways. One of those ways is through the dissemination of disinformation, the intentional communication of false statements, and TikTok is an extraordinary avenue through which to disseminate disinformation to millions and millions of people.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling.
Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live every trading day. Balance of Power, live around the world, only on Bloomberg.
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
All right, it's time now for Top Calls. Some of the analyst action in focus this morning. And first up, Applied Materials getting upgraded to a buy at KeyBank Capital Markets. The analyst says that he sees AI-related devices as growth drivers, and KeyBank also upgrading Lam Research. Next up, we have Bank of America downgrading JetBlue with a sell rating. The firm says that the airline looks expensive and is also facing execution risk. Bank of America also cutting Southwest for the same reasons. And finally, we have Crocs no longer a buy, according to Williams Trading. The firm is downgrading the shoe company to a hold, saying that the outlook for its brands has dimmed since the December fashion footwear show in New York City. Matt, were you there?
I wasn't there, but what is with people, on the airplane wearing like pajamas and Crocs?
Okay.
Get dressed, for goodness sakes.
I just took a red eye from San Fran. I was in my pajamas, but I had Hokas on, not Crocs. You're not seeing any part of my foot.
I think it's no better, Katie.
No better.
It's
well,
no better.
I felt great, so that's what matters.
Okay, your comfort is key.
Thank
now,
you.
Bloomberg has learned that Rio Tinto and Glencore were in talks about combining their businesses to create a $160 billion mining behemoth. But those negotiations are no longer active. Bloomberg's Joe Doe covers all things industrial, so he found it interesting. I found it interesting. We can speculate about how cool it would be, but let's start out by saying chances of this happening right now are pretty low.
Yeah, who knows, right? I mean, I was talking to a couple of investors right after we broke the news yesterday, and they had the big question mark above their heads. It was like, okay, yeah, there's a lot of synergies here that make sense, but I think it was interesting. One of the things that these two investors in particular came to was the question of culture. And I don't think that's something to overlook, right? I mean, you have Glencore, which we've noted is this swashbuckling trader mentality.
Always in court.
And then Rio, who in particular, probably the past half decade, have been quite conservative. I mean, they blew up an Aboriginal site in Australia that was one of the biggest disasters we've seen in the mining industry in a long time, and they have changed their tune with Jakob as their new CEO. So I think there's a lot behind the scenes on that.
Right, the behind the scenes, if these discussions took place as recently as late last year, but not currently active, as y'all have reported here, then why were they talking about it? For these two giants to even come together and have the discussion, the rationale is almost more important right now on the changing winds of the industry.
Right. I mean, listen, my colleagues in London, Archie, Dinesh, and Tom had put in the story, listen, you know, Rio's on a bit of a high here. They bought out the rest of a copper mine for about $3 billion. They purchased Arcadium, which is a lithium miner. That was like their biggest M&A deal in years. People had been wondering when the CEO would finally kind of splash in. So they could be riding a bit of a high of looking around the market, seeing what they can do to be more acquisitive. But mainly, one of the things that's going on in the mining space right now is how can you get your hands on high-quality copper assets? And Glencore has them in a way that Rio Tinto currently does not.
We've talked about culture, we've talked about copper. Let's talk about coal, because Glencore has a massive coal business. We know that Rio probably isn't too interested in the coal business. Is there any possibility it could get spun out? I feel like we've had this conversation before.
Right. I mean, you know, Glencore had considered spinning out the coal business after buying it off of Teck, and then, of course, their investors said, no, keep it, because there's so much money to be made in coal right now.
Is this dirty coal or clean coal?
Thermal, excuse me. We're talking, the met coal is especially attractive, whatever.
It's not lab-grown coal?
No lab-grown. But, yeah, listen, this is the major issue between both companies. It is the question of, does Rio suddenly want to have coal assets, something it got out of, and does Glencore actually want to be getting into the iron ore business, which is something it doesn't do? And I think that's a tie-up of question. Where do the investors actually feel about this? Where does the company feel about this? I mean, listen, the synergies are obvious. Oh, you can combine all the base metal assets. You have copper. You're talking about the energy transition. That looks awesome. And then you have the iron ore and the coal and the bulks, right? And those are just staples across the globe and something that is always going to be making money for a long time. But again, listen, the talks are currently not active. It's very interesting. I'm sure in the mining space, we're going to be hearing investors talk about this for a while because, hey, it is interesting, right?
Yeah. And it would be huge if it happens. Bloomberg's Joe Doe, thank you for joining us, telling us exactly what's going on underneath the surface here. Now, coming up, we're going to go back to that story about Goldman giving its two top executives generous retention awards. Like I've been saying, it's payday. We're going to talk about that next in Wall Street Beat. This is Bloomberg.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizon's Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
All right, welcome back to Bloomberg's Open Interest. Taking a look at the stock market right now, we're 21 minutes into the Friday trading day, and we have a rally on our hands. The S&P 500 up by about 0.9%. It's big tech that's in the spotlight right now, leading this market higher. The Nasdaq 100 up by about 1.3%. We had been a bit higher at the opening bell, so of course we'll see if these gains fade. But for at least right now, a big broad rally that's also extending to your small caps, with the Russell 2000 currently higher by about 0.9%.
And it's time now for the Wall Street Beat. Goldman handing out an $80 million retention package to its two top executives. Bloomberg's chief Wall Street correspondent, Sridhar Natarajan, joins us. Is this the John Waldron appreciation package? I mean, if you look at this package, you expected David to stay around. Your packages really go out to vest through the next 5 years. They start vesting after that point. John was somebody who, maybe I guess a year ago now, we were talking about as someone who could potentially become the CEO of Carlyle. Then Harvey Schwartz took over. So he signaled as an executive that could go somewhere else. Is this a bid to keep them on board?
Well, 2 points. A, Shonali, there's plagiarism. The John Waldron retention package was a term that I pointed out to you because it was pointed out to me by other Goldman partners because this has been in the water for the last 2 months. And let's talk about why we're even affectionately dubbing it that way. When was the last time a CEO of Goldman Sachs left that role to go run a private equity firm or go run some other investment firm? Usually they go into Washington, D.C., become Treasury Secretary. Yes, that door has been closed for senior Goldman leaders for a while, but David Solomon was doing well. He had a pep in his step. The firm has been doing really well, and it didn't look like he was going anywhere anytime soon. However, there were tons of questions about John Waldron. He has been by David Solomon's side for about 30 years now. For the last 6 years, he's been the number 2 at the firm. And in the last several months, there has been so much conversation inside Goldman Sachs as to what will happen to John Waldron. Will he stick it out now for another few years because David Solomon does not want to go anywhere else? Well, the answer is the board is saying, here's a very pretty retention package to make sure that he sticks around at least until 2030. And the fascinating part about this retention package, they don't have to do anything. The stock doesn't have to double. The stock doesn't have to triple. They don't have to meet any earnings target. The only target that has to be met here is John Waldron and David Solomon have to be in that seat until 2030.
That's wild.
This is a little inside baseball here at Bloomberg. Sometimes there's a little strife. Bloomberg News, print versus television. You were just promoted to chief Wall Street correspondent on the print side. Wasn't that always your title here in TV?
On TV,
yeah.
Right. Two things can exist.
Hey,
we're co-presidents.
We walk in pair. We're completely fine, man. Don't try and add strife here.
Pull up my comp screen. Goldman Sachs. Will Shaker, our producer in the control room. Goldman Sachs versus the rest of Wall Street. I love to use the comp function. It defaults to a 5-year time period, which I think is a great default. Goldman Sachs is outperforming every other bank on Wall Street. Don't they deserve this money?
100% they're outperforming every single Wall Street bank. In fact, if you go back a couple of years when they actually made the decision, after a lot of furor internally, where a lot of senior partners actually pushed the CEO to abandon that ill-fated foray into consumer banking, get rid of most of that, they've actually refocused into what they do really well, money management and investment banking. It's been a good period for that, and Goldman Sachs has truly outperformed.
Really important here, on money management, they're also getting pay tied to carry. The reason I think this is fascinating is a lot of the big private equity firms have moved away, actually, from carry to pay in stock. So why is Goldman then paying in carry?
Again, this is fascinating because you have to go back to the early days of the Solomon Waldron leadership back in 2018. In fact, through the first 2 years, so much of the conversation was about how that leadership at that time looked at how they were paid relative to how some of these private equity firm executives were paid, and actually felt that they were underpaid. They had explored so many things. They had explored getting a bigger cut of the carry back then. They had already added a part of the carry to the partnership pool. They wanted a bigger cut of the promote from the SPACs when SPACs were a thing. So this has been on top of mind for a while. They've made some additions. This turbocharges it further just to make sure that Goldman Sachs can go out there and say, you don't necessarily have to leave for a private equity firm to be paid like a private equity titan.
All right, Shri, congratulations on the new title. It's great to see you. That is Bloomberg's Sridhar Natarajan. Now, coming up in the next hour, we'll speak to Gabriela Santos of JP Morgan Asset Management about her investing strategy under Trump. We'll also speak to Mark Rosen of Catalyst Brands, formerly of JCPenney, now of Catalyst Brands. We'll discuss. This is Bloomberg.
DraftKings hit a milestone in the second quarter of 2024. For the first time as a public company, it turned a profit.
Is this a new era for DraftKings?
There's an inflection from when you're cash flow negative and you're operating off of equity raises from the past to when you're self-funded and you're cash flow positive and able to control your destiny a lot more.
You've had your first quarters of profitability now. Does that take pressure off? Does it increase pressure?
I think it increases pressure. I mean, once you start making profits, people expect you to make more, and all of a sudden you're valued on a multiple of those profits as opposed to the theoretical what could be. So very important, I think.
When you're cash flow negative, you've sold a vision of what the company should be working on, and you're very focused on working on that and delivering against that. When you've pivoted to profitability, the world of what you can work on is a little bit open, and there's a lot of different ideas, and it requires more focus than ever to make sure that you are prioritizing on the most important things that are going to deliver the most value.
DraftKings' solid standing in a booming sector gives them the luxury to play the long game. They're not under pressure to cut costs.
When you have really strong revenue growth, you don't need that. If you look at where we are today and where we want to be and where we believe we will be, the vast majority of the incremental EBITDA is not coming from any cost reduction. It's coming from increased revenue.
We don't feel like we need to cut costs because we're growing our revenue so much. We want to grow our revenue into our existing cost structure, and there's no need to reduce the cost as long as we're being efficient with what we allow our cost growth to look like.
Bloomberg brings you breaking news 24 hours a day, powered by 2,900 journalists and analysts in more than 150 offices across the globe. Bloomberg Television. Context changes everything. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
CBS News on the Hour, sponsored by Progressive Insurance.
I'm Deborah Rodriguez. 15 months after the war began, Israel's security cabinet has almost assured enactment of a ceasefire in Gaza and a hostage release beginning Sunday. It's approved the agreement signed by both sides and sent it on to the full cabinet. The BBC's Sebastian Usher on how that prisoner-hostage exchange will take place.
This is going to be releases on a weekly basis, 3 hostages every week, and depending on whether they're alive or dead, 30 Palestinian prisoners released for each one of those hostages.
The number of victims continues to rise. Correspondent Cammie McCormick.
Secretary of State Blinken says he's confident the deal will go into effect on Sunday, and humanitarian groups are gearing up. Margaret Benoit of Doctors Without Borders.
There are so many things to do. It is overwhelming, but you can bet that we're making all the plans necessary to be able to seize the opportunity of these precious weeks. And of course, what we're calling for is for the ceasefire to be sustained, for this to be the end of this horrific war.
Israel says it hit 50 targets across Gaza in just the past day.
Confirmation hearings underway in the Senate for South Dakota Governor Kristi Noem, President-elect Trump's nominee to be Homeland Security Secretary.
Being safe within our borders here in America is critical, and yet Americans feel less safe than they have felt in decades.
A new step toward lowering exorbitant prices for weight loss injectables like Ozempic and Wegovy. They're both on a new Biden administration list of drugs that'll be hashed out with Medicare. CBS's Alexander Tin.
Biden officials say they think it is unlikely the incoming Trump administration will be able to change the drugs they picked or upend the talks without Congress. That's because much of the process is spelled out by law.
The Supreme Court could rule on a TikTok ban today. It's scheduled to take effect Sunday. CBS's Jan Crawford.
TikTok users, they've already started checking out these other apps looking for possible replacements. But some of those, including this one called Red Note, they're also owned by Chinese-based companies. So those national security concerns concerns would not necessarily go away.
TikTok CEO is expected to attend President-elect Trump's inauguration Monday. China's foreign ministry says Mr. Trump spoke with the country's leader Xi Jinping by phone today. Her family says Tony Award-winning British actress Joan Plowright has died.
Do you think we ought to have a glass of champagne round this one?
Yes. Why didn't anybody think of that about a few hours ago?
She appeared in the documentary Tea with the Dames with Maggie Smith and Judi Dench. Plowright, who was married to the late Laurence Olivier, was 95. This is CBS News.
Love.
Breaking news from Washington. The Supreme Court has just upheld the law banning TikTok beginning Sunday if it's not sold by its Chinese parent company. Apple has suffered an AI setback.
Apple is putting a halt to sending out news summaries generated by artificial intelligence. News organizations complained that they often got facts and headlines wrong. Apple deployed the update to developers working with a beta version of the software, sidelining the AI feature for news headlines. The company plans to restore it when it's working properly and eventually roll it out to all users. Last year, Apple unveiled new iPhones built with generative AI. Steve Kathan, CBS News.
Back to TikTok. Bob Dylan jumped on last minute. A verified account features a 50-second music video montage. Fans have been weighing in with comments like, "You've got 30 seconds, King." Deborah Rodriguez, CBS News.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been in U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Happy Friday, everybody. We made it to the end of the week. I'm Alex Steele here with Norma Melinda. She's joining me for the 2 hours. Paul Sweeney is still off today. We have a great 2 hours lined up for you. We're going to break down the Supreme Court ruling on TikTok in just a moment. Also, we'll be breaking down what's happening in the market. It's a fierce rally. A lot of options also expired today. Steve Sosnick, Chief Strategist at Interactive Brokers, will be joining us. And plus, M&A is supposed to pick up. Where do we see it? We're going to take a look at the life sciences sector with the U.S. Senior Leader for Life Sciences over at KPMG. So we got a lot over the next 2 hours. All right, let's go right now to June Grasso, a Bloomberg legal analyst and host of the Bloomberg Law Show, joining us on the Supreme Court upholding the law that threatens U.S. TikTok shutdown. What do you know?
So this was a unanimous decision, and what basically it does is it says that national security concerns are more important than any of the free speech concerns raised by TikTok or the content creators who appealed at the Supreme Court. And this is pretty much expected, maybe not that unanimity of it, but during the oral arguments, justices from across the ideological spectrum were questioning whether TikTok really was sort of safe, whether TikTok, the Chinese parent, might somehow use the data of millions of Americans and store it, or use data against Americans, or engage in propaganda campaigns on TikTok. There were all these huge concerns raised, and there wasn't that much concern for the free speech rights of the 170 million Americans who are on TikTok, or TikTok's free speech rights, or the content creators' free speech rights. So, and it's not unusual, I think, because usually when there's a case that says national security, it's like a big red sign to judges saying, well, this isn't my area, this is the area for the executive branch or the legislative branch. What do I know about national security? So it tends to fall by the wayside in light of other concerns.
So this was largely expected, as you mentioned, and then also we should be seeing this action actually being taken place on Sunday, if I'm not mistaken. What is it like in action? Are we seeing the app being removed from people's phones that are here in the U.S.? Is there any discussion about what this could look like, or is it an unknown?
So what will happen is TikTok, according to what its attorney said at the Supreme Court, will go dark on Sunday. And the point of this really is to, I think, and I've read other people talking about how it's to send the message to those 170 million Americans that you're not going to have TikTok anymore. But actually, TikTok can remain. If you have downloaded it already, it will remain on your phone. The problem is not with what TikTok's going to do so much, but what the companies that support the platform, like Apple and Oracle and Google, what are they going to do? So there is this theory that President-elect Trump could say, my Justice Department is not going to enforce this, so don't worry, Apple, don't worry, Oracle, we're not going to enforce this. But then, are they really going to take that, are those companies really going to take that as assurance when the fines would be massive, $5,000 per use? So just imagine what those fines would look like.
Per person with a TikTok downloaded app.
So people I've talked to said they doubt that that Apple and Oracle would actually support TikTok. And so then TikTok would gradually lose people, and it would gradually sort of disappear. But there are the funny thing is that a lot of TikTok users calling themselves TikTok refugees are going to other platforms now, but a lot of those platforms are Chinese owned as well.
I was seeing that.
Right.
Yeah.
Red Note.
Exactly.
Yeah.
So legally, for the companies like you mentioned, Oracle and Apple, you can download the app now until Sunday. You just can't update it anymore, and that's where the issue is.
Yeah.
Do they have a legal standing?
You mean Apple and or
yeah.
I don't think so. At least they weren't involved in the Supreme Court as parties in the Supreme Court case. They don't really have what I would say is legal standing. But, you know, millions of TikTok users might say that they have legal standing, and they weren't represented at the Supreme Court. So it wasn't so much a standing issue as just this national security, you know, concern overweighing everything. And also what's kind of unusual, and the justices talked about how there was secret evidence, and we haven't seen the evidence of that. Apparently some of the senators and the lawmakers have seen about the dangers of TikTok. And in fact, the circuit court, the DC appellate court that ruled unanimously as well to keep the ban in place, didn't even use that evidence to make its decision. They just relied on what Congress said. So it'd be interesting if we ever see that evidence, if it exists.
So what could actually be done to change this decision? You mentioned Trump. Are there any other Hail Mary situations in terms of the fate of TikTok?
Well, I mean, right now, the president is Biden still, and he has said he's not going to, or it's indicated he's not going to do anything about TikTok. When Trump is inaugurated, the ban will already be in effect. There is a question, there is a provision in the ban that gives 90 days to a president if TikTok is engaging in sincere negotiations to sell the platform, if ByteDance is. And I'm not quite sure, you know, legally speaking, whether there'd be an issue about whether it starts to run with Biden or starts to run with Trump once the ban's in effect. There's that. The Washington Post has reported that Trump has suggested he might issue an executive order to put the ban on hold. I mean, that would be questionable legally, an executive order like that, but I don't know who would oppose it at this point.
Right.
So there are and as I said, Trump can just say to the Justice Department, don't enforce this. You know, he spoke with the president of China today and said they discussed TikTok, and nothing more than that. So, you know, we'll see. There are things that can be done. I mean, Congress could pass another law. And, you know, with the weight that Trump has with Congress, as we've seen from these, hearings and everything else, maybe they could pass another law and, take away the ban.
June, we appreciate it. I know it's always hard to jump in right after breaking a Supreme Court decision, but we very much appreciate you. June Grasso, Bloomberg legal analyst and host of the Bloomberg Law Show. Let's get more on this now with Matthew Schettenhelm, Bloomberg Intelligence media litigation analyst. He is standing by on this news. Again, the news Supreme Court has now upheld the law that threatens to shut down TikTok's social media platform in the U.S. as soon as Sunday. All right, Matthew, were you surprised by the decision from the Supreme Court?
I was not surprised. The oral argument last Friday was consistent with this. The question in my mind was really, was this going to be unanimous? I thought there was a chance TikTok could win a couple justices. With looking quickly at the opinion here, it looks like the court wrote a per curiam decision for all 9 justices. There were a couple concurring opinions from Justice Sotomayor and Justice Gorsuch, but both of those they expressed a different view, but they went along with the judgment. So this is a 9-0 loss for TikTok. This is what we expected after the appellate court ruled against TikTok earlier this year. The Supreme Court is doing exactly what that appellate court said, and so the law remains in place. The ban takes effect on Sunday.
Well, Matthew, in your note, you mentioned that Senate Minority Leader Chuck Schumer was signaling support for a ban extension. What does it look like now that we've heard that the Supreme Court will be upholding this ban?
Yeah, so the logical way for this ban to go away is not the president issuing an executive order. The president can't change federal laws by executive order. What he can do is convince Congress to change course. And I think TikTok got its first real good news yesterday when the Democrats' leader in the Senate, Chuck Schumer, came out and said, look, there's real concerns about TikTok, and we still need to force a sale, but let's give them more time. And when you have Chuck Schumer for the Democrats and President Trump for the Republicans both saying that, to me, it's a pretty good sign that Congress is going to find a solution to extend this, to push it back at the very least. The problem, though, is that the timing here, this takes effect on Sunday. And Congress is, unless they have unanimous support in the Senate to do this, I don't think they can do it very quickly. It takes a matter of days to debate these provisions. And so the harder question is practically when Congress can get this done with the ban looming and set to take effect on Sunday.
The other question is who would buy it. Morgan Stanley actually saying that Amazon could be a good suitor for TikTok. We heard the Chinese government saying that, well, maybe if they sold it to Musk. What do you think?
Yeah, the big question is what are they selling, and will ByteDance sell anything to me? Because there's real doubts, I think, that ByteDance would ever agree to a sale of the algorithm, or that China would concur with that. And so that's the first question of what are we even buying here? And is that resulting product going to have the secret sauce that makes TikTok what it is? And so I find it difficult to speculate about that, given we don't know what could be for sale here, and there's a real possibility that ByteDance is not going to be in a position to do a sale at all. So far, they're if they succeed in Congress in pushing this back, maybe they keep playing hardball and not seriously considering a sale.
Matthew, what does this mean for U.S. competitors? Of course, we have Meta, Snapchat. If you think about Instagram Reels, they're all willing to hop in on this situation.
Yeah, it's great news. I mean, right now we are looking at a ban taking effect on Sunday. And if TikTok goes dark, as TikTok's counsel told the Supreme Court it would if the court didn't issue a stay, those users are going to need to go somewhere. And so it's a great opportunity for Meta, for Google, for Snap, for those users are going to need to find a new location. And so I do think, as I said, there's a pretty decent possibility that Congress turns the lights back on. And so then maybe they go back, but this is disruptive. And so that creates an opportunity for TikTok's competitors.
Yeah, and also disruptive for all the influencers who are making money off of TikTok. Like, what
Small
do you do?
businesses?
Small businesses, same thing. All right, Matthew, thanks a lot. Really appreciate you. Matthew Schettenhelm, Bloomberg Intelligence Senior Litigation Media Analyst. We'll be watching that. Are you a TikToker?
I am.
You are, okay.
I did tell Mark, our producer, that I might sob on air if I heard about this news, but,
you didn't.
I'm holding it together.
You held firm. What would you miss the most? Like what?
I miss the food recipes. If I'm traveling somewhere, I look up my entire itinerary through TikTok, people who are on the ground there telling me what to do.
Huh. And you can't do that through like Instagram.
I don't find that the same search engine capabilities are the same
so
on
you use
Instagram.
TikTok as a search engine?
I do, largely. I wrote a story about that for Bloomberg, actually.
Wow.
I'll have to send it your way.
I have to think about this. I'm going to ruminate on this possibility. John Tucker and I do not do that. But we
I
could.
do. Oh, I love the cat
hush it.
videos.
Oh.
Aw, I love cat videos.
Of course you're
I could
joking.
definitely watch hours and hours of cat videos. All right, coming up, Steve Sosnick is Chief Strategist at Interactive Brokers. He'll be joining us for his take on the market as lots of options expire today. Happy Friday. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom. This Bloomberg Business Flash. We're being brought to you by Interactive Brokers. Trade over 10,000 U.S. stocks and ETFs, U.S. equity index options, U.S. treasuries, and more on your timetable. Learn more at ibkr.com/around the clock. Yeah, it is a stock rally to close the week. Tech shares leading the way. Intel, NVIDIA, Apple, Tesla, they're among the most active. Intel shares up close to 8% after that report. It is a takeover target. Among the earnings, this was after the close yesterday. J.B. Hunt Transport Services reporting fourth quarter earnings per share trailing consensus expectations. As a result, they are down 7.2%. Applied Materials, Lam Research, they were raised to overweight from sector weight at KeyBank Capital. Regulators probing General Motors over concerns that more than 870,000 of its full-size pickup trucks and SUVs face the risk of engine failure. And was looking at Meta, which, of course, is Instagram, one of the competitors to TikTok. The reaction now is a little curious. Initially, it was up. Right now, shares Meta Platforms, they're down 0.25%. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Lauren, Alex.
All right. Thanks so much, John Tucker. I got to say, the market wants to go higher because Fastenal just turned around up 2%.
After their earnings this morning.
Yep, right. But you mentioned it was down. It just turned. I mean, I don't see any necessary headlines like maybe less bad is than could have feared, or it's getting better is helpful. However,
well, they were initially blaming, the downturn in manufacturing in the U.S. for their woes, and that hasn't improved. So, yeah.
No, exactly. That's, the momentum is we're just going to buy some stocks today. It feels like that's
all sectors, all 11 major industry groups are in the green right now.
Yeah. Let's get some more insight on this. I'm Alex Steele, by the way, Norma Linda, in for Paul Sweeney. Joining us, one of the best with the internal details of the market. I love guys like this, and I love Steve. Steve Sosnick is Chief Strategist at Interactive Brokers, and he joins us now, and he looks at all the stuff under the hood, right? Like who's buying, who's selling, what are they doing, what options look like, the whole thing. Steve, is today just a buy the equity market thing? Is there a theme here for you?
Good morning, Alex, and I hope I can live up to that introduction. Thank you so much.
You're so welcome.
But it is pretty much, we did sort of wake up with a let's buy the market. I think we've had a huge change in sentiment this week, and it was largely driven by the bond market. Think about where we were this time last week when we were selling off hard because the labor economy was too good. But so it's all been about, perceptions about Fed rate cuts and Fed activity. It did show you that the market at some level cares, the stock market, I should say, some level cares more about rate cuts than it did about a strong economy if we sold off on a good economic numbers. But once the bond market stabilized and, when we were up around 470 or so, now we're back around 460, a little bit below it on the 10-year. That's really helped stock spirits a lot. This morning's numbers, you were talking about Fastenal, industrial production came in way above expectations, as did housing starts. So, ultimately a good economy should trump all, no pun intended about inauguration. But certainly, and also, I just think that people are back in the buying mode. And you did mention expiration today. We all focus on these new zero DTE options, but it's important to remember that expiration means that everything is a zero DTE option today because they're all expiring today.
Well, Steve, things are looking good, as you just noted. Of course, we ended last year up more than 20%, and we're seeing us in the green today. But there's also this argument that things are too expensive, valuations are too high. Where do you fit in this idea?
Well, Nora, I can't argue with the fact that valuations are high, and really can't say they're not too high, but too high is very much of a relative statement, right? Too high compared to what? And it's, and certainly they're not too high for people to want to pay for them right now. The thing about valuations is over time, they do tend to work. As a timing measure, they stink. Markets can be irrational much longer than you can remain solvent. And so it's important to know that if you're buying stocks here, you are paying a real premium for their earnings power, or in some cases you're paying a lot, even if they're not earning very much. But from a timing measure, that can be problematic today, tomorrow, 2 years from now. It's not. There's no timing component to valuation.
So talk to me about funds and positioning. So we got CTAs, so commodity trading advisors. They're more trend following. We got the vol-controlled funds that reallocate based on where volatility is. Where are those guys?
You know, the trend followers are still in place. I think they got shaken out a little bit, but you know, if you're a short-term trend follower, certainly you're back in the game today, trading from the long side. In terms of volatility, it's been interesting because we have had a fair amount of realized volatility recently. You know, in the last, let's say, 20 sessions, we've had pretty much 9 or so where you've had the S&P 500 move 1% or more. So there has been a return of volatility. You wouldn't know that from looking at the VIX today, which, you know, I like to remind people that, you know, VIX is not strictly a fear gauge, though it does play one on TV. It is the market's best estimate of volatility over the coming 30 days. And we've gone from fairly high anticipation of volatility. You know, we were about 21, I think, you know, a week ago, and now we have a 15 handle. I'll argue there's a lot of what I'm going to call known unknowns coming at us in the coming 30 days, whether it's you know, executive orders, whether it's earnings season, which comes into play very strongly. You know, we have a Fed meeting in there, even though that meeting is not really an in-play Fed meeting. So for the market to flip from having a deep respect for volatility to, you know, basically, you know, being very sanguine about it is an interesting turn of events in just a short period of time.
Well, we just got CPI and PPI data this week, along with some other economic data. How are you really viewing where we stand right now with inflation in the U.S. and how it's impacting U.S. equity markets?
Well, I mean, certainly the markets love this number. And again, I think that you know, when you put in perspective the move that we had based on, you know, a nice but small beat on monthly CPI and PPI, those are okay, and that's, you know, we certainly want to see inflation moderate, but you know, we're starting to see commodity prices tick up higher. I know Alex is all over commodity prices, and we have seen those tick up. And you know, it's nice to look at the core and say let's exclude food and energy, but ultimately, when you talk to people about what constitutes inflation, they're going to tell you about the price of gas and the price of eggs, and that's not to say things like you know, lumber and copper and some other things, which have been seeing some steady gains, and probably, you know, I'm not a commodities analyst, but I can't see that pressure easing too much with the need to build a big piece of Los Angeles back in the coming days.
Completely right. Weeks. I was just talking to Matt Miller about that when he was on TV with me yesterday. 100% on that. You need, and that's copper too. It's lumber, steel, it's the whole thing. Scott, you totally, Steve. Sorry, I always call you Scott. And I don't know why I do that. My bad. Steve, you didn't disappoint. You totally nailed it. Steve Sosnick, Chief Strategist at Interactive Brokers. We appreciate you. Thank you so very much. The geopolitical risk, though, still definitely in the market. Front and center is what's happening between Hamas and Israel. Israel's security cabinet has now approved of a ceasefire and hostage prisoner exchange deal with Hamas, and this, of course, paves the way for a weeks-long pause in fighting in Gaza. Joining us now is Oliver Crook. He's Bloomberg Europe correspondent, and he joins us now. He is in Tel Aviv. Oliver, can you tell us more about what this ceasefire looks like and what we can expect?
Yeah, so listen, when this was first announced on Wednesday night, first by the Prime Minister of Qatar, and then we heard, you know, from Donald Trump on Truth Social and Joe Biden, they'd already hit a few stumbling blocks within the first 24 hours where basically Benjamin Netanyahu was accusing Hamas of sort of backtracking on some of the agreements. Those were resolved by this morning, which then left it for the Israeli government to have a vote on it and to basically try to move forward with the ceasefire, which should begin on Sunday. The major hurdle has now been crossed because the security cabinet, this is a smaller cabinet, apart from the larger cabinet, which is now reviewing this, they approved to move forward with this. And what this would now constitute is the first phase of what is, according to the architects of this whole ceasefire proposal, the first of 3 phases, right? And the first phase would begin on Sunday. This would stop fighting between the IDF and Hamas for 6 weeks, beginning on Sunday. It would begin an exchange from hostages for prisoners held by the Israelis to be returned, and that'll begin on Sunday with the release of, if this goes forward, 3 female hostages. And again, over time, over the next few days, a few hostages will be sort of released progressively, and that'll go on for the 6-week period of time. What this will also bring is more aid into the Gaza Strip, which has been, as we know, completely devastated, completely decimated, more than 45,000 people killed. The infrastructure is completely shot, but it would also mean the withdrawal of Israeli troops from the most populated areas within Gaza to the eastern corridor of Gaza, not out of Gaza, but is a significant step forward and the first and most lasting, and if it passes, durable ceasefire since this conflict began about 1 year and 3 months ago.
What are the ramifications if either party were to breach this agreement?
Well, I mean, I think it would be a complete disaster, and there are a number of mechanisms in place to basically monitor whether or not that happens. That is going to be a joint effort by the Qataris, by the Egyptians, by the Americans. These are the people that brokered this deal. They're going to be in Gaza monitoring whether or not there are any violations going forward. But again, there has been intense pressure, particularly domestically here in Israel, to really release these hostages. There have been a great many different views on how to continue fighting this war. There are the right-wing members within this coalition government who actually threatened to leave the government if this ceasefire deal was approved, while there have been a lot of protests on the streets here in Israel to try to get these hostages back. So that pressure there, and of course the pressure from the U.S. administration currently and the incoming one as well.
Can you talk to me about who was helping to mediate this deal?
Yeah, so listen, this was all being held basically in Doha, and there were a number of different participants within this. So it was the Egyptian government, the Qatari government, and basically both representatives from the Trump administration and the Biden administration. Really, they wanted to sort of cast this as a sort of bipartisan and bi-presidential sort of effort to get this over the line. And as you probably saw from the press conference, yesterday or the day before, when Biden came out and announced it, he was asked by the press, basically, who should get credit for this? Should it be President Trump or should it be you? He said, is that a joke? But, it's hard to ignore the fact that the pressure has really been ramped up over the last month. And even Benjamin Netanyahu, the first person he called after this was sort of agreed to was Donald Trump. And in this sort of press release that the Israeli government put out, the first thank you went to Donald Trump. It was a much longer sort of thank you. And at the end, he said, I also thank Joe Biden for his efforts as well.
All right, Oliver, really appreciate it. Always love chatting with you. Oliver Crook joining us, Bloomberg Europe correspondent, joining us on that ceasefire between Israel and Hamas. Nora, from where you guys sit, how do you guys think about geopolitical risk on the market desk, right? Because it's the thing you can't price, and it's the thing that always is tricky to manage when it happens.
It's definitely an unknown. And of course, our team on the U.S. equities team, we're always monitoring to see what is going on in terms of price action, how it's hitting different sectors. I cover, of course, U.S. real estate stocks, so there's some things there when you think about trade. But more or less, I've now been covering U.S. defense stocks.
Oh, have you?
So that's a new area of coverage that I'm taking on. It's going to be interesting. But of course, when we think about this, or we think about what politicians are saying, both in the U.S. and abroad, about the war and all the ongoing situations that we have occurring, those can, of course, affect U.S. defense stocks as well.
Yeah, that's really interesting. I am also interested to see how your real estate beat is going to play out, particularly in LA.
Most definitely.
After those wildfires. He and Nora are the best. All right, we're going to be back with more. So we're going to talk more about what to expect from the incoming administration, particularly when it comes to M&A. We'll talk to the sector lead of life sciences for KPMG and break down those expectations. This is
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom. This Bloomberg Business Flash. And to end the week, stock rally. All 11 major industry groups in the S&P 500 higher. Technology shares leading the way. You have Intel shares, they're rallying after the website's semi-accurate said the company may be an acquisition target. SLB, Schlumberger, the oil services company.
Can't say Schlumberger. That's LB, man.
Just say Schlumberger. They know what you're talking about. They gained on plans to return at least $4 billion this year to shareholders. And right now, as we look at the markets, the S&P 500, 59 points higher, up 1%, 59.96 on the index. The Dow Jones Industrial Average, 369 points. The NASDAQ 100, 325 points higher. That is up 1.6%. All right, so looking at competitors, Meta and Snap, interestingly enough, they are both down, these competitors to TikTok. The Journal says it has started to appear increasingly likely the Biden administration or the incoming Trump administration will find a way to prevent a U.S. ban on TikTok from taking effect on Sunday, as both seem to be looking into such a move. And then you see this headline on CNN says, Trump to CNN, quote, "I'll be making the decision on TikTok's fate," end quote. You know, point out the Supreme Court and the Congress, which passed the law, are equal branches of government.
Right, but he can tell, he can not enforce the ban.
Yeah, so there's that.
There is that. There's that.
Put that in your pipe and smoke it. We check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Nora and Alex.
All right, JT. I'm Alex Steele, alongside Norma Melinda. Paul Sweeney is off today. One of the staples that we've seen in the market and the expectations, just ask any bank CEO, is the unleashing of M&A in the next Trump era, right? You got deregulation, lower taxes, and lower rates, and all of that should trigger some massive M&A. So I wanted to get some understanding of maybe what sectors and what that actually looks like. Joining us now is Kristen Pothier. She is U.S. sector leader for life sciences at KPMG, and she joins us now from Boston. So you guys recently issued the findings of 2025 Healthcare and Life Sciences Investment Outlook. We've seen like $492 billion worth of value so far of M&A in just the last 3 months. What are you guys expecting?
Thank you. And thanks, Nora and Alex, for having me on the line. I am fresh from the 2025 JP Morgan conference in San Francisco, which is where all the healthcare and life sciences companies come to run across Union Square together and start the year and do deals. And I would say that the sentiment is so exciting for life sciences as we go into 2025. And there's a couple of different reasons for that. First, M&A is back, right? And so when you look at that and you look at all of the innovation that's needed for pharma to continue to fill their pipelines, for precision medicine to be able to come to the brink, for diagnostics companies to recover, for device companies to recover, that is the key to what we're seeing. And after a pretty tepid 2024 and some conservatism in 2024, M&A is back, and M&A is exciting within healthcare and life sciences, and then the innovation that it comes with.
Well, you mentioned that AI is expected to be a significant driver of life sciences deals this year, but you particularly point out an impact in tools and diagnostics. Can you talk to us a little bit more about that?
Absolutely. AI is an ecosystem approach in healthcare and life sciences. So it's not just about what it can do for drug discovery, but it's also about how it can just shuttle a patient from one place to another, whether it be in basic drug discovery all the way through till diligence and all the way in through patient care. And what we're seeing, especially in tools and diagnostics, is those have always been those gatekeepers or those gate openers to our therapeutics, our targeted therapeutics of the future. With AI, and AI being able to affect pathology diagnoses, and able to affect blood diagnoses, it allows us to more carefully, more efficiently, and more rapidly shuttle patients from one place to another. And it's really coming out to be much more effective than human eye. as well. So it's very exciting. It was all over JP Morgan this week, and it will continue to be something that's highly valued and highly a part of the ecosystem, healthcare and life sciences.
What type of M&A do you expect? Are these going to be transformational deals? Are they going to be bolt-on deals? What are you guys modeling out?
Yeah, absolutely. And we're seeing a big mix this year. As you can see, there is already several $10+ billion deals that have happened within healthcare and life sciences over the last couple of months, as both our pharmaceutical companies and our device companies really rechange their portfolios and focus on that innovation. We also see a number of bolt-on deals, because as those portfolios continue to shape, there's going to be areas where a pharma company only needs a certain piece of that innovation puzzle to be able to come in, and that's a bolt-on deal. Also, what you'll see in life sciences in general is a lot of that innovation isn't coming from our biggest pharmas, it's coming from our smaller biotechs. And so therefore, just by nature, those would be smaller deals in general. You see the volumes continue to go up and the deals continue to be bite size and a little bit bigger than that, but it allows us to be able to have that detailed diligence that goes along with it and be able to really understand what's going on with those portfolios.
Kristen, according to your firm's most recent survey, what factors are most likely to impact deal activity this year, according to what you've heard from respondents?
Yeah, the number one is getting the most out of the innovation that's coming through each one of these deals. And what I mean by that is being able to look at the most innovative deal making that's coming through with the diligence that goes along with it. And so that is one aspect of it, is pure innovation. What is innovative and what isn't innovative in the space? The second really is it going to be able to highlight an entire ecosystem and really be able to factor in not only what the pharma's doing, but what our physicians are doing, what our patients are doing, and what our diagnostics companies are doing as well. That is that second component. And then the final component that is really important here as we think about M&A is valuation. And there is a mix of what both our corporates are thinking about valuation and our PEs are thinking about valuation. What we've seen is for our corporates, they are expecting valuations to continue to go up. That's because they've been in this market this entire time. They've been looking at all of these different assets, and the higher the innovation, the more the valuation continues to tick up. Maybe not to the levels expected that were happening in 2021, but right around there. Our PEs, though, on the other hand, are much more conservative. What they're seeing is, from a sell side perspective, if they're going to sell the